This is Bloomberg Open Interest. Let's get a quick check on what's going on in markets right now. We do still have red arrows on the S&P 500 and the NASDAQ. So we haven't had a turnaround in the cash trade even after the 8:30 a.m. CPI print came in showing a decline, a contraction month over month, which should be good news in terms of the Fed, in terms of the economy, and indicate that we get a cut sooner than later. Nonetheless, we had a 37th record high yesterday, so maybe investors are selling that news, Katie.
All right, let's get to some of our top calls. The analyst action in focus this morning. And first up, Jefferies cuts Olive Garden owner Darden Restaurants to underperform. The firm said that the chain could lose share if it needs to add more promotions in order to lure those cash-strapped diners. Even still, stock is unchanged. Next up, we have Morgan Stanley cutting On Semiconductor to underweight. The analyst says that the chipmaker faces a number of headwinds across its automotive division. Stock a little bit lower just moments into the trading day. And finally, we do have Raymond James initiating coverage of Citizens Financial with a market perform rating. The bank's management setting expectations for weaker net interest income at an investor conference recently. And of course, that bank reports next week, Shanali.
And we're going to stick on banks. JP Morgan, Citigroup, Wells Fargo kick off earnings season for the banks tomorrow. For, of course, the second half of the year, followed by Goldman Sachs, Bank of America, and Morgan Stanley next week. Joining us now with a preview is Erica Najarian, UBS equity research analyst for large cap banks and consumer finance. And let's start with what we have today, because with such a drastic move lower in 2-year yields and 10-year yields, you do see the money center banks being the biggest decliners here in the KBW Bank Index. Citigroup, JP Morgan, Bank of America, Wells, all down on the day. What is the ultimate impact of such a sharp move lower?
So keep in mind that the money centers were huge outperformers so far this year, massively outperforming the mid-cap bank index or the KRE. And so I think the setup today is, oh gosh, September is live. Not only is it live, there's an 88% chance that we're going to get our first cut sooner rather than later. And so this is a bit of a reversal of the trade. Everybody was hiding in the money center banks in terms of higher for longer. And now, given especially the valuation, and if you pair that with, the coming elections, I think you're really starting to see that trade reverse and regional banks get a bid.
It's interesting because you do see already that expectation starting to moderate for net interest income. If you see a move this much lower in rates, does it mean people want to borrow more, or does it mean that there's just more pressure yet again?
Yeah, so let me set up sort of the Goldilocks scenario that I think the market is hoping for in terms of what happens after the Fed cuts rates. So the Fed cuts rates, and then regional banks will get relief in deposit costs. There's going to be some relief in terms of commercial real estate refinancing, at least a perception of relief, and then it's going to be enough to reinvigorate loan growth. I don't know if all of this will happen, but I think that's the initial knee-jerk reaction to the CPI print.
Erica, the other thing that happens after the Fed cut rate, if they do it in September, is we get either a Trump presidency or a centrist Democrat. What difference does that make to these big banks? Because if you watch, for example, Powell's testimony, the Democrats are grilling him on being, they allege, a representative of the big banks, and that's a bad thing from their perspective.
Here's the thing, though. We got two headlines essentially this week that even under this administration, we're seeing some relief in some of the regulatory constructs. So this whole Basel III endgame rule that would be really, really tough on capital for the banks, Chair Powell said he'll repropose that. And there's nothing more effective for banks than time. Second, they're also dealing with changing how to calculate the GSIB surcharge, which is huge, right? Because that could lower the capital requirement for big banks. That being said, if we do have a Trump presidency, that reaction is going to be, gosh, we need to buy the smaller banks because there's going to be potentially, a logjam breaking in terms of consolidation.
And so we're talking to you on the eve of earnings season for these big banks, which is a lot of specific catalysts there. But we have a question from a client saying, shouldn't a rate cut be good for bank portfolios? And that kind of bleeds into a question I wanted to ask, which is, what do the bank equities actually trade on? Because it feels like, again, we're in earnings season. We get some specific news. Maybe they trade on that for a day. But then it just feels like this entire sector goes back to being a macro story.
It always is going to be a macro story. I think that while we can debate on the impact of the first cut, how many cuts, I think at the end of the day, how to get more breadth in terms of portfolio managers owning more banks than just JP Morgan, BofA, and Wells is proving to the market that the risk reward isn't like the reward is underperforming the S&P and the risk is zero. And, that's what you've seen over the past 15 years. You've seen, obviously, the global financial crisis and then last year's regional bank crisis. So it almost feels like for banks to truly pop off, to use a Gen Z term, they really need to go through a real recession and proving that it's an earnings issue, not a capital issue.
Erica, there are some of your rivals here on Wall Street that believe that it is a market for Wall Street, that Wall Street banks might do better than the traditional Main Street banks in this environment because of this rebound in capital markets and investment banking. There's skepticism around that, too. How much do you believe that could really fuel profits going into the end of the year?
So I think there's definitely, the comps are super easy, right? The activity levels last year were super weak. And so you could definitely see activity levels in banking and equity capital markets, debt capital markets especially, continue to be strong. But I also feel like, the election is such a pivot point. And so you could see whether it's loan demand or M&A activity, some sort of near-term pausing. And then once there's certainty, whoever wins, then you could really see 25 activity levels soar from here.
All right, Erica, thank you so much for coming in. Erica Najarian there of UBS, right ahead of the big day for banks earnings. I know it's like your Super Bowl, right? So what time do you wake up on bank earnings day?
Like 3:30. I can't wait. It's like opening presents in the morning.
All right, it will be exciting for sure. Coming up, more financial news, more Wall Street beat for Sonali, a guilty verdict for Archegos Capital Management CEO Bill Wang. That and more. This is Bloomberg.
All right, this is Bloomberg Open Interest. Let's take a look at the markets right now in the wake of that CPI print. You can see the S&P 500 pretty much flat, maybe 0.1% higher, even though you had this big rally in the bond market. 10-year yields down 9 basis points, almost 10 basis points on the day. Big rally there, not matching the S&P 500, but where you are seeing action is in the small cap index. That Russell 2000 screaming higher, up 2%. So the S&P 500 couldn't hold its bid, but small caps and bonds is where all the action is at this morning, Sonali.
And Katie, it's time now for the Wall Street Beat, the most talked about stories in finance. And first up, we have to talk about none other than Bill Hwang, found guilty of criminal charges stemming from Archegos' 2021 collapse. And remember, it's him as well as his co-defendant, the former chief financial officer of Archegos. This was a heated trial. Paul Davies of Bloomberg Opinion asked a good question. Could Archegos happen again?
It's a great question, really. And I mean, I think that's everyone's worst nightmare, right? That when you think about the black swans that are still out there, do we have something like that hiding in plain sight? Is there another $36 billion family office that is just being a little bit too risky?
Yeah, I guess it was interesting to see. I mean, the testimony was amazing, right? And to see the relationships between these traders and their prime brokerage, they were so chummy that there was just too much trust, and that's what made it happen.
And some things in the market have changed. Of course, Credit Suisse is no longer really in this market, but some things really haven't changed. They tried to really change up swaps rules. They tried to change up family office rules. None of that happened at the end of the day. So time, I guess, will tell.
And there's some great details, a lot of TikTok that has been in the reporting around this case. I thought this was interesting from the jury. We were talking yesterday about how the judge was saying that both sides were boring the jury, but one of the jurors who asked to remain unnamed, he said that he was on the fence during most of the trial because he worked on Wall Street for more than 3 decades. But he said that Hwang in the end condemned himself because he was trading on such a large scale and had that manipulative impact on stocks.
Can I just shout out to Chris Dolmetsch?
Yes,
the Bloomberg reporter who covered this did an amazing job. I mean, following what he was doing in the T-Live, and he was covering other trials as well.
He was.
So working around the clock, Chris Dolmetsch, you have to write a book about this trial.
Ava Benny Morrison and Sridhar Natarajan and Miss Relena Golfapoulou, just a total all-star cast. But next up, inside Ken Griffin's Citadel Securities, a strategy for handing even more of Wall Street's trading over to the market maker. That strategy is starting to take shape. It's a nascent strategy, which would have firms deal with clients here. Citadel Security would be dealing with banking clients, while Citadel Securities handles the behind-the-scenes mechanics. It's fascinating, guys, because this is a year in which they're already on track to hit half-year profits, according to Bloomberg's reporting. And remember, this is an extension of what we've seen, bank trading desks weakening under capital rules. It ties into the broader story. And Ken Griffin really coming out on top here.
Yeah, a really timely story. I mean, just to oversimplify it, it sounds like this is basically white label trading that they're doing, right?
It is, and it's interesting. It reminds me a lot of what other firms like Jefferies and Co. have been doing, because they have been outsourcing trading to other investment banks, while the biggest of banks have more and more constraints, and instead turning to things like prime brokerage, lending to hedge fund clients, instead using those balance sheets when it works.
But it is just another story of these big banks losing business to upstart competitors, right?
You know, this is not quite the same, but you think about just these like synthetic risk transfers that are happening, hedge funds that are taking on loan books from banks, and that's exactly another extension of just banks offloading to the non-banks in a bigger and bigger way.
All right, that was Wall Street Beat. There's always so much to talk about, and we could do like an hour. Someday we'll do an hour show on the Wall Street Beat. Right now, let's get to the trading diary, what you need to be watching this week. We'll get more Fed speak from Raphael Bostic today at 11:15 a.m. Then at 6:30 tonight, President Biden holds a news conference at the NATO summit as it wraps up there. That will be unscripted, and it will not be pre-taped. It will be live, so people are paying very close attention. Also paying close attention to JP Morgan tomorrow, plus Wells Fargo and Citi. Those 3 banks kick off Shinali's Super Bowl big bank earnings on Friday. And we'll get the University of Michigan consumer data, some more data for the Fed. Coming up, we're going to talk to Steve Eisman from The Big Short, senior portfolio manager at Neuberger Berman. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld.
And U.S. inflation cooling broadly in June, and it's added to the case for a September rate cut.
A conversation with Steve Eisman of Big Short fame. He tells us where he sees opportunities as the bull market leads to lofty valuations.
And the most exciting turnaround you've probably heard of by now. We're going to be speaking to the CEO of Abercrombie & Fitch as the retailer bounces back from the teen fashion graveyard. But before we get there, let's take a check on these markets. Of course, about 90 minutes after CPI dropped, you can see the S&P 500 pretty much treading water here, up maybe 1/10%, if you can call it that. Tech, meanwhile, taking a bath. You can see the NASDAQ 100 turning around from its previous gains, now down about 0.2%, even as that bond market rally continues to build. The 10-year Treasury yield currently down by almost 11 basis points. It just keeps going.
And as we've been saying, the big story of the morning is that inflation print. U.S. core inflation slowed more than expected in June. Let's get more on today's data with Michael McKee, Bloomberg chief economics and policy correspondent. The market obviously is calling this a massive win here. Odds in September really rising now for that first rate cut. And obviously that sharp move you saw in the 2-year and the 10-year. How convincing is it all, Mike?
It's pretty convincing, and Wall Street, you're welcome. We're getting you almost there. The Fed looking for more confidence on inflation that it's going to continue to go down, and we certainly saw that today. Headline inflation for the past 2 months has disappeared. It comes in negative 0.1 this for the month of June, and the year-over-year number is at 3%. Core CPI month over month just up 0.1%. And 3.3% year over year. Those are the kind of numbers that the Fed wants to see. What they really want to see is a broad drop in the rate of inflation, and that's what they got. Some of the categories that moved are the things that you would expect. Gasoline goes up and down. It was down 3.8%. Motor vehicle insurance, it's been a bugaboo, and it went back up again after falling last month. Airfares, we saw in the Delta earnings story, way down. But the owner's equivalent rent is the big news of the day because the Fed's been waiting for home prices to start to fall, and we're seeing that reflected in the lowest increase in owner's equivalent rent since August of 2021. So where does it leave us all? Well, you take a look at what is happening in the markets, and you can see that we are now basically priced for a September rate cut, a few basis points short. Probably if we get some decent other news, we'll be over one full cut by the end of the month. Probably too early for a July cut, but September getting priced in. And now look at what we've got for next January, 3 cuts by then. So the market growing more and more confident that the Fed is growing more and more confident and able to cut rates.
All right, Mike, thanks very much. Michael McKee there talking to us about the inflation data we got this morning, CPI data. Joining us now is Steve Eisman, Senior Portfolio Manager at Eisman Group, Neuberger Berman. He is famous for betting against subprime mortgages in 2007. And Steve, thanks so much for joining us on our inaugural week. Really appreciate it.
You're welcome.
I'm sure everyone always asks you for the next big short. You know, what
Every
else
time.
do you see falling apart?
They want to know, when am I going to predict the end of the world?
Yes.
Is it today?
Well, yeah, look, I predicted the end of the world once. It was pretty awful for everybody. I have no interest in predicting it again, and there's no data to say that it's going to happen, so we should just move on.
All right. All right, let's move on. I was going to ask about CRE, but I guess we can do that at the end. What about this inflation data? What about rate cuts? I mean, how much does that matter to you? I will say, I will preface this with, Katie cares so much about the Russell 2000.
I really do.
She loves the small cap
They're
stocks.
so small.
And they've reacted
But you
very
like little
positively.
fuzzy things? Is that what you like?
Cute little
things.
What
Okay.
are they going to do better?
What do you think about? Do they need a cut? Like, do you?
I don't
do you
invest in small caps, so it's not something that I
I guess he
particularly
doesn't.
focus on. So we can move on again.
All right.
I want to move on. I actually do want to move on to the biggest of big names here. I want to talk about Apple because you've
Okay.
talked about it a lot already on our program throughout the year, but you've talked about it in the vein of the artificial intelligence during the longer term. What about the near term, Steve? Apple, the other kind of high flyers you've seen in the market here, what is the case over the next year to be invested in big tech given where valuations have gone? do you have to bear some pain in between if you get to that AI?
Well, nobody likes pain. I don't make short-term predictions. I think that's impossible. And the only thing I could say about this,
My iPhone.
your iPhone, is that this looks a little old, doesn't it?
It's very old.
This is quite old, people.
I don't know if I'm representative
of... The whole point about Apple and AI is very simple. I mean, today, the obvious winners are NVIDIA and the other, what I'd call arms dealers. And then you have, Microsoft, Amazon, Meta, Google, Oracle, people who have big cloud, big database businesses. And after that, we'll see. But one thing that's very clear to me is companies will be doing their AI, whatever they do, in the cloud. And consumers will want to use whatever AI apps are out there, and they're going to want to use it. I'm going to take your phone again, on this phone. And let's be very clear, this phone that she owns doesn't cut it.
No.
Okay? I have the newest phone, so that might cut it for a while. But once there's some apps on that people are going to want to use, you will buy a new phone.
Oh, not until I crack the screen.
Okay, but you're close. I'll buy a new phone, a new iPad, maybe I'll even buy a new laptop. That's what everybody's going to do. It's going to be the biggest, what I'd call refresh cycle, maybe in history.
So before we get there, I mean, you make a really interesting point about, okay, you have sort of the picks and shovels is what people have been calling about it. You have NVIDIA, et cetera. You have data center. People are very excited about utilities right now. What about those downstream wagers? You said that's sort of we'll see territory, but what does the decision tree look like when you're evaluating who could be the eventual users and then winners of AI?
I mean, I think that's a question that is just impossible to answer. I mean, there are no apps. I mean, what you're hearing from a company like Accenture, for example, is half of their business, which is outsourcing, is doing well, and their consulting business is flat. And why is that? The outsourcing business is where they're doing very well because companies are hiring them basically to clean up their data so that they can eventually then use it for AI. Then maybe they'll get hired to do consulting. So a lot of stuff that's happening underneath the surface is for a lot of companies is cleanup in preparation to be able to use AI. What apps are going to be used? I mean, I don't know. I've never programmed, so I would have the faintest clue. But whatever those apps will be, people will use it. And, for people, individuals like ourselves will use it on our phone or our iPad.
I think even Katie will upgrade. When Siri gets smarter, when AI is really integrated, I think Katie will join that upgrade cycle. You own NVIDIA also.
Yes.
How long-term are you invested? I mean, if I ask about earnings in the third quarter or fourth quarter, I'm sure you don't care, right? Because you're looking years ahead.
Whoa. Don't say I don't care. I care. But do I think that's why I own it? No. I mean, I think this upgrades cycle of what's going on in tech is going to last years. And so I think you have to own the large, big cap tech stocks. The interesting thing to me within tech, which is a thesis, it's not mine, I'm not smart enough to come up with this thesis, but I think is one of the more interesting theses that I've heard is that, prior to the last few years, software always outperformed hardware. In the last few years, hardware has outperformed software because of what's going on with NVIDIA. But this argument that's been made is that one of the things that AI is accomplishing is it's crushing the cost of creating software. Like at some point, even you and I will be able to create software.
Yeah.
So if that's the case, that might mean that, one of the reasons why software companies have been so successful is they have these enormous moats. Well, if the cost of creating software collapses, maybe those moats aren't so high.
How long does it take to get there?
Well, that's the question. I mean, it'll be years. But I think if this thesis proves to be correct, what you'll see is a gradual derating of software companies.
But is it so? You want the hardware and you like the big cap. Is it only $3 trillion companies that you like, or what else?
No, I go smaller.
What else besides Apple and NVIDIA?
I think, look, in bad times, people focus on balance sheets and credit quality. And in good times, they focus on stories. And since I read a lot of comic books, I love stories. So there are in equities, two great stories. There's everything having to do with AI and all the tentacles from AI and who benefits, data centers, et cetera. And then there's infrastructure.
Right.
And those are the two dominant themes. Those are the two dominant themes in our portfolio.
But the concentration risk doesn't worry you? I mean, we talk every day about how there's no breadth, right? NVIDIA, NVIDIA, NVIDIA. Like, does that, everyone's in this trade?
Well, I don't own 100 stocks. I own 30 to 35. So I think you can construct a portfolio where, and there's more to do than just those two themes, but those have to be pretty big themes in your portfolio.
Let's talk about infrastructure because we are rattling towards the November election.
Yes.
And you've made the point that maybe it doesn't
I was going to bring the
matter.
conversation there if you didn't.
Perfect. Well, here we go because
We'll get to debt next.
You think about the Inflation Reduction Act and what that's done for infrastructure. Of course, there's also been an infrastructure bill signed under President Biden. That's obviously created this huge theme around infrastructure. If we get a change of administration, I mean,
well, let's just say
affect...
it's not just the IRA and the IIJA.
Right.
There's onshoring, there's the data centers, there's the dramatic improvement that we need to do in the grid, and there's greenification. So is it possible that in the Trump administration, some of those dollars were reallocated away from greenification towards some other things? Certainly. Does that mean that the infrastructure theme is dead? Not at all. It'll move
So it's
to different
Trump-proof,
areas.
kind of is what you're saying.
Well, the overall theme is Trump-proof. Remember, if you're going to change the IRA, you need 60 votes in the Senate, which is not easy. But could things migrate from green to more traditional energy? That's possible.
You know, it's interesting. On the other hand, you told our colleagues about a month or so ago that by August it would become clearer and it's easier to then start creating trades off of what is happening in the election. We're only a month away.
Yes.
What are you thinking?
100% certainty Donald Trump wins.
Interesting.
Really?
100% certainty.
Is that investable, though? What do you do?
Well, let's talk about why.
Yes.
So forget about, whether Biden's going to run. It doesn't matter at this point to me whether Biden drops out or does not drop out. And this was a prediction that I made a month ago, which is the convention's in August. And that was a pregnant pause, by the way.
I liked it, yes.
I learned that
We're waiting
40, 30 years ago.
Drama. Please keep going.
The protesters that have been on the college campuses are going to converge in Chicago en masse. And what I'm quite sure is going to happen is they'll burn Israeli flags, they'll torch the Stars and Stripes, they'll spew whatever they spew, and the whole country's going to watch, and the whole country's going to be appalled, and the election will be over as they burn those flags.
All down to that.
Yeah,
And you don't even think
that'll be the final nail.
if Biden gets out of the way and is
Doesn't matter.
replaced with someone that we all rally around.
I don't think it matters.
Steve, there's another policy issue here, too, and you kind of feel it in the fracturing of the Democratic Party on this issue, is what if the Democrats start to lose some steam going into November writ large? What if you have a red sweep? Are you considering that scenario?
I think that's
what it
possible.
means for equities?
I think that's possible. And, under those circumstances, well, there's what's an investment and what's a trade. So, you had Erica on, who I've known, I don't even want to say for how long I've been Erica, we've known each other. So the regulatory apparatus will get replaced regardless. It probably means somewhat less stringent capital standards for banks, and the banks will all have a nice pop. But after that, I think it's over. I think that's just a trade.
Interesting.
Because I don't think there's a story about why you want to invest in banks like you want to invest in NVIDIA.
So it's not investable necessarily, but it's tradable.
It's definitely tradable. My partners and I, we don't really trade, so that's not something that we do, but anybody who wants to do it, God bless.
All right, Steve.
Not done.
Okay. You have 30 seconds.
30 seconds. But, other things, whether money gets restructured or maybe there's more onshoring, for example, because of tariffs. That would be an investable story.
All right, Steve, stay with us. Don't go anywhere. We're going to take a quick commercial break. Let's just quickly check on these markets. Of course, not much has changed in the past 10 minutes, but S&P 500 pretty much treading water here, down a little bit. You can see small caps absolutely crushing it. Maybe we'll talk about that more. Anyway, Steve Eisman.
No, we won't.
No, we can talk about it.
Steve Eisman is sticking with us. This is Bloomberg.
The commercial real estate situation, which is, it's significantly downtown office and related retail and things like that. This is something the banks have been working their way through for the last couple of years. I think it'll take more time, more years to work all the way through it. It doesn't seem to be a systemic problem or one that threatens broader financial stability. It does threaten bank profitability and those sorts of things, but it'll be with us a while. We'll just keep working our way through it.
Fed Chair Jerome Powell speaking before Congress yesterday about commercial real estate. Of course, it was one of the most really paid attention to watch clips of the week. Let's get some thoughts here on the sector with Steve Eisman, who's sticking with us, Senior Portfolio Manager at Eisman Group at Neuberger Berman. And you think about these concerns in the real estate market, and even if you don't think it's a systemic risk, what are the continued ripple effects in terms of the pain that investors might see?
Well, I think about 50 to 60% of CRE debt is held by the CMBS market. So that's an investor problem. That's not my problem. That's somebody else's problem. And then maybe 40% is held by banks. Very little of that is held by large banks as a percentage of their assets. Some regional banks have significant risk, and it's a problem. But, they're able to pull shtick. As we always like to say in my business, a rolling loan catches no loss. Meaning they just roll it until they can't roll it anymore. So, commercial real estate is a problem that's sort of glacial in that way. There'll be restructurings. Banks will have issues. Some regional banks, I don't know if any regional banks will go under or not, but it's not a systemic issue.
If I think about the biggest problems facing us, unfortunately, I know that you don't care that much about the federal deficit and debt.
Yes.
But how come? If we're paying more than $100 billion a month in servicing costs,
I'm going to take out my violin, okay?
But more than we pay for the military.
Okay, so can I let me say a couple of things. Number one, I'm going to put you in the camp of what I like to call the the deficit crowd.
Oh. Yes, I'm there. I'm right
You're
there. Me and Lisa.
So I'm not an economist. But I understand arguments. And literally every single word that people are uttering about the deficit today has been uttered by somebody for 40 years. Now, in my business, being too early is being the equivalent of being wrong. But I've been a year too early. I've been 2 years too early. I've been 40 years too early. So clearly it's more complicated than the deficit people like to say. Is there a point where it becomes an issue? Sure. But you know how you'll know? Instead of on a day like today, where the 10-year is down, how many basis points is it down?
11.
Just 11. You'll walk in, and it'll be up 50, and you'll say, you're the deficit. And then it'll be relevant.
Yeah, but Steve, this is exactly the same as housing, right? At some point...
40 years. 40 years. Long time.
Yeah.
It's really just a very, very long... And the argument as to why I think it's just not that relevant... Excuse me, my earpiece fell out.
You don't need your earpiece.
Is that... it has to be that the fear about the deficit causes people to start to walk away from the dollar. That's the feedback loop. So let's think about that for a second. Why is the dollar the reserve currency of the world? It's actually very simple. Big money has to park its money somewhere. And they're only going to park it in the most liquid, safest bond market in the world. And that's the U.S. government bond market. Until there's actual replacement, the U.S. dollar will be the reserve currency of the world, and what you're talking about is just going to be academic. It's not China. It's not Europe. No offense to all you crypto people. It's not going to be crypto. So until somebody can show up and show me some replacement for the U.S. government bond market, I'm just not concerned.
And it remains to be seen if that'll happen in the next 40 years. But before we get there, I do want to talk about the state of shorting. Of course, you were in The Big Short. Steve Carell played you. Great movie. But it feels like this environment...
That's on my tombstone already, by the way.
It's already carved in.
It's carved in.
It's funny, but in any case, it feels like the state of shorting in this market. This just feels like an environment where companies won't die. And you see these high valuation, high flying stocks, and it just feels like there's a lot of temptation out there to short. But how are you thinking about short selling?
I don't short for clients at all. I short itty bitty little bit for myself once in a while. What I would say to people is, number one, a couple of rules about shorting. Shorting a stock purely because you think it's expensive is a death wish. You have to have a fundamental reason to be short a stock. Is NVIDIA expensive? I mean, yeah, it's expensive, but earnings have tripled. So, you could have made that argument a year or so ago, and then earnings doubled or tripled, whatever they did. So, I think the economy is fine. Is it slowing a little bit? Sure. Are delinquencies up a little bit in consumers? Okay. But there's no fundamental case to be massively short things. I mean, are there individual stories maybe you could short here and there? Sure. But to go after, the market, I think is insanity.
But, we have the DOJ going after short sellers. I mean, don't they serve an important purpose?
They do serve an important purpose. I don't understand why the DOJ goes after short sellers.
The other thing, too, I believe you were once short Tesla for a certain amount of time, too. What were the lessons learned there? Because you've seen so many people get squeezed on trying to short that stock in this market.
I've been shorted. I haven't been shorted. Look, I think you can at times short Tesla when the fundamentals are deteriorating. And then people stop focusing on the fundamentals and they start talking about, the dream of auto taxis or AI or whatever, and then it becomes impossible. So Tesla's not a stock to be short long term at all.
Steve, we could talk to you forever. Our producers are yelling at me.
Are they seriously yelling? They're not yelling. Come on.
They're like, commercial break. We got to pay for this. Steve Eisman, thank you so much for coming in. Pleasure spending some time with you. Steve Eisman there of Eisman Group, Neuberger Berman. This is Bloomberg.
All right, a quick check on these markets. Stocks taking a turn lower. The S&P 500 at session lows right now, down 0.3%. Small caps power on, up about 2.8%, even as big tech down about 1%. Coming up, Abercrombie & Fitch is back. We'll speak to the CEO next. This is Bloomberg. Well, don't call it a comeback because they've been here for years. We're talking about the retailer that was one of the hottest brand names in the early 2000s, and now Abercrombie & Fitch is back. The company has been reborn by strategic investments and a resurgence of 90s fashion, and now the stock moving at a pace faster than even NVIDIA. Joining us now, I am thrilled to say we have Abercrombie & Fitch CEO Fran Horowitz. And Fran, I mean, the stock alone has just been staggering to watch over the past couple of years. But let's talk a little bit about the future from here, because we think about Abercrombie & Fitch. Your market is really millennial men and women. But are millennials alone enough to fuel future growth beyond what you've already built?
Hey, good morning, Katie. Thanks for having me, and congrats on the new show. Yeah, so to get right to your question, what's really exciting about the renaissance of Abercrombie is the fact that we have really changed our addressable market. You know, the Abercrombie in the past that people reference was much more of a teen consumer. We've really opened up that space for Hollister and made that the global iconic teen brand. And Abercrombie has truly aged up. The consumer today, they start to shop with us in their early 20s. They still stay well into their 40s. So that's a big shift for us that will clearly support the sustainability of the business. Additionally, we've added so many new categories. The way I like to say it is in the past, right, we were a jeans and T-shirt company, and today we're truly a lifestyle brand.
And I mean, it's an interesting strategy. Of course, you think about who was shopping at Abercrombie in the early 2000s. They're now those millennials that are shopping at your store. And I want to talk about how they're shopping, because if you take a look at the margin level, it seems that digital is a bit more profitable than bricks and mortar, for example. I'm curious how you're viewing those two different platforms.
Yeah, listen, both are profitable for us. Our most profitable consumer, frankly, is our omni consumer. That's the consumer that shops on each and every channel with us. We have said for many years that stores matter to this consumer, as does digital. I like to put it as stores plus digital equal magic. And again, just to reiterate, that omni consumer is our most profitable consumer. This customer uses the store a little bit differently than the Hollister consumer does. This consumer does a big part of the business online. The majority of our business is digital, but it doesn't mean that they don't come to the store to transact. That could be to pick up something that they purchased online and pop in to pick up. It could be to do a return or an exchange, see what's new for the day. The Hollister consumer, that business is closer to about a 30% digital business. He and she still see the mall as a very social place with their friends, like to come in on the weekends and go shopping with them. So interesting difference between the consumer.
I'm really interested, Fran, in how you're thinking also about price points here, because you have a consumer. We had inflation data this morning showing that inflation is starting to cool down, but you do still have many consumer-focused companies feeling that strained client. And it's interesting, over the years, a lot of people have gone to Abercrombie and Fitch to do things like go shopping for bridesmaids' dresses for their weddings. Are you finding yourself able to deliver a cheaper option in many ways, or a more affordable option, at least?
Well, to your point, our wedding shop has been a terrific success for us, and that goes back to my point about expanding the customer, both the age cohort as well as the products that they are willing to buy from us and the confidence that they find in what we're putting out there. What we see from our consumer is that when you have the quality and fashion at the perception price that they are willing to pay, they are willing to spend. Coming off of a record Q1, that would tell you that our product voice and experience is lining up really well. And that's true, in fact, what we saw around the world, right? We saw a double-digit increase in our brands, our regions, our channels. So all in, it was really a terrific quarter for us.
The other area that investors and clients are both really watching pretty closely is your expansion in activewear. What is the size today of the YPB business, and who is it taking share from? Is it grabbing share from the likes of a Lululemon or a Alo, for example?
What's YPB?
The Athletic.
So YPB is our performance brand. It stands for your personal best. It's something that we launched in Abercrombie Adults about 2 years ago. And it's a great question, Janelle, because the reason that we created that brand, that sub-brand for us, was because we focus on the long weekend for our consumer. That is what our whole mindset is about. What is that consumer doing on their long weekend? And they said to us, you know what? One of the things that we're doing is we are being active with our friends. We're working out, we're hanging out, and we actually leave your store, go down the mall, and buy this product from somebody else. So we know you can do it just as well, if not better. So we put together a test about 2 years ago. We saw a strong result from it, and we've seen terrific growth from it for the year over year.
Fran, one of the things that led to your success is you used to have sizes that were just for teens or people who are in incredibly good shape. And as you said, you've become more inclusive, and we've at least I've read with, good fabrics, a great price point, design obviously are all important. But the stories today about weight loss drugs lead me to wonder about a resizing in the other direction. Obviously, it's not going to be so fast that you can't keep up with it in terms of your product mix. But do you see that actually making an impact, the Wegovy's and Ozempics, or does it not really make a big enough difference for you to notice in terms of the sizes that you're selling?
Yeah, Matt, to date, we really haven't seen a difference. I understand your question is a little bit more long-term.
Yes.
I think the way that we think about it is that the consumer shops when they have the need for something, right? And that whether that's an increased size or a smaller size, I'm excited today that Abercrombie offers an entire wide range of diverse sizing, different fabrics and quality of things. We launched something called Curve Love a few years ago in our denim area for women's. It's almost half of our business today. that's just a curvy individual. It doesn't necessarily mean, what particular size that they might be. So there's always an opportunity for the consumer when they see, again, that price, the product, voice, and experience lining up, and a product that they're enjoying and needing, they're shopping with us.
And Fran, I want to talk a little bit about inventory because a lot of retailers, a lot of apparel makers in particular, learned a lot of hard lessons about inventory during the pandemic. It's interesting. If you take a look at Abercrombie, you actually place your orders a few months or weeks in advance for some of your categories. That compares to an industry strategy about 9 months ahead of time. Do you see that potentially becoming a risk again? If we saw another shock, I mean, how vulnerable does that sort of short lead time on inventory potentially leave you?
Katie, like in anything, we have to strike a balance in our business. So we don't run all of our business that tight. We strike a balance. But one of the biggest lessons that we learned from COVID, to your point, is that you can do a lot more with a lot less. And keeping lean inventory and making sure you're on top of listening to the consumer has been a win for us. Over the past few years, our logistics team has figured out how to make sure that they get the product to the consumer at the right time. So we have a playbook that we continue to exercise, and I'm excited about the agility that the team has built into the process.
And Fran, we don't have much more time left, but I do want to talk about promotions. We've seen a lot of your peers turn to promotions. If we take a look back to your first quarter earnings, you actually reported fewer promotions. When you think about pricing in this environment, a weakening consumer, still high prices, how does your promotional strategy fit in?
Listen, the way that we talk about our promotions, we've talked about this for years, is that we focus inwardly on what our consumer is reacting to. I work with the teams literally every Monday. We have our business review and we go through what's working, what's not working, and we react to the business as such. We do not get influenced with what's happening around the balance of the mall with other retailers. We really have to focus individually on what's working for our business. And back to the prior question with the leaner inventories and making sure that we're testing and we're reading and reacting, it's a matter of just trying not to get too long on things that you don't know a lot about.
Our thanks to Abercrombie & Fitch CEO Fran Horowitz. We thank you so much for joining us, of course, talking us through the strategy on what has been a very high-flying stock. Now we're going to get a check on the markets now with Bloomberg's Abigail Doolittle.
So it's interesting, Chanelli, we're seeing something today that we have not seen in 8 days, and that is a down day for both the S&P 500 and the NASDAQ 100. Take a look at the S&P down 0.3%, but the tech-heavy NASDAQ 100 down more than 1%. So we have some real selling developing over, let's call it the last hour or so. The 10-year yield, interestingly, down off of its lows after that lesser than expected, softer than expected CPI print. You would think this would be helping stocks, but given the fact that we were up 7 days into today, maybe just taking a little bit of, chips off the table. Or it could also be the fact that we have the dollar weakening against the yen strengthening up 2%. In fact, let's put this into the perspective of a chart that shows the yen. This is really pretty interesting. So if we take a look at the yen, it's right down on its 50-day moving average. The last time that happened, and it didn't happen in such a decisive manner, we did go down to the 200-day moving average, which in this case would suggest we may be going back down to 151. So that funding out of a cheap yen, well, today it's not happening so much. If that continues to not happen, we don't know that's the case because this support may very well hold. But if it doesn't, we may continue to see some weakness for stocks. As for some of the individual movers, let's take a look at the shares of Delta Airlines because they are under pressure, although also off the lows, down 6%. This, of course, after they put up a bad quarter. Earnings declined significantly on a year-over-year basis. The outlook for the current quarter, very, very weak. And it's not a demand issue. They have too many seats and plus the rising price of fuel pressing on profits. PepsiCo down almost 1% off of its lows. Organic growth up just 1.9%, really missing the mark. Volumes light. Apparently people are eating less salty snacks. I wish that were true for me. And then Pfizer off of its highs, up just 0.5% at this point. But talking about the weight loss drugs, and of course we can't not talk about that one-day pill that they are developing, early stages. Analysts are encouraged, but they say, Katie, more data is needed.
More data is needed. Bloomberg's Abigail Doolittle. Thank you so much.
I got to get some. I'll be a study case for Pfizer on this.
That's perfect. Matt is willing to enroll in any trial you have. Coming up on this program, though, what the fall of the Chevron doctrine means for corporate America. Highlights from our conversation with Catherine Judge, Columbia Law School professor. This is Bloomberg. right, it's time now for our daily Wall Street Week conversation. And today, we're examining the consequences of overturning the Chevron doctrine. Wall Street Week's David Weston spoke with Catherine Judge, Columbia Law School professor, about the potential impact of this decision on banking regulations.
If you look back historically, Chevron was actually one of the key vehicles that facilitated deregulation during the 1980s and 90s. So as you just said, the core idea of the Chevron doctrine is when a statute is ambiguous, that's going to be treated as a delegation to the relevant agency to figure out the best interpretation under the circumstances that they're facing using their expertise. And so in the 1990s, that was a mechanism through which they said, look, banks can actually engage in a far broader array of activities than we previously thought. In the short run, I think banks are celebrating this as a win. Business is celebrating this as a win. Longer term, it's really hard to know. It really creates a lot more legal uncertainty. It does reduce the relative certainty regulators are going to have regarding whether or not their rules are going to be respected, and it puts courts in the driving seat in a way that I think could really shake things up.
Well, just unpack a little bit that legal uncertainty. I mean, I still have a bar card. I'm a lawyer, and so when I read some of these decisions, I said, this is good news for the lawyers because there's going to be a lot more litigation because it's encouraging companies to bring challenges. But we have a lot of courts in the United States, in America. We typically only have one regulatory agency. So what happens when a court in California disagrees with a court in Texas about what the statute means?
I would say presumably it's going to have to go to a higher court, and that is precisely the right question to ask. So now when a regulator comes out with a new rule in advising their clients, a bank regulator or bank advisory attorney is really going to have to engage in a two-step analysis. First, here's what the regulator is saying that you're allowed to do or what the requirements are. But second, there's a lot of legal uncertainty. So whether or not that's going to be the rule at the end of the day is going to take a significant amount of time to actually become resolved. So it certainly means that there's just going to be a lot more uncertainty in the bank regulatory environment in the years ahead.
So I'm going to ask you do something you're not going to want to do, is just speculate, but we don't know. But you teach regulation and legislation with respect to particularly financial institutions. As we look at various regulations that are pending, including the Basel III, but not limited to that right now, do we think that may affect the way they go about making their rules? Because now they're very conscious of the fact they're going to have a court of some sort looking over their shoulder right quick.
Yeah, so two things. One, I think it's certainly going to affect the way that they undertake rulemaking, Basel III, and otherwise. That's partly because, again, Loper Bright just overruled Chevron, but there were also a number of other significant Supreme Court decisions that really allow courts to scrutinize far more closely the decisions that regulators are making and the processes through which they're making those decisions. So there is a risk it's going to make regulators a little more gun shy and a little more worried about making sure they've crossed every single T and have dotted all of their I's before they promulgate a regulation. That being said, bank regulators are also bank supervisors, and they have an ongoing duty to really promote the safety and soundness of the institutions that they oversee. So you could end up with a world where if regulation is not able to keep up with potential changes in market dynamics or risks that supervisors are seeing, a lot more work gets done through that supervisory process, which is far less transparent and far less uniform.
Well, so this is a fascinating point I had not really thought about. It may shift away from the regulatory approach where they have a notice and comment, everybody comments on it, we know what's going on, as opposed to, I'll call it prosecutorial discretion of a sort, through the supervisory function. That's a very different kettle of fish.
It is a very different kettle of fish. It's one banks have had to deal with for a long time, but the question is relative importance. One of the ways of understanding Chevron, particularly as it's been narrowed in recent years, is it created a real carrot that really encouraged regulators to undertake notice and comment rulemaking, which is a very time-consuming, very resource-intensive process, because at the end, they knew they were going to get this carrot called Chevron deference. Now that you've taken that carrot away, it puts a lot more onus on the regulators to think, well, what is the right tool of the various tools I have available for trying to achieve a particular end? It still might be regulation in some set of circumstances, but it could also be supervision. For banks, it could be things like the living will process that we've seen being a mechanism through which you get kind of change over time. It could also, for something like the CFPB, be policy making through enforcement. Rather than clarify what certain terms mean, use enforcement policy be a mechanism through which you make policy. So again, I think it certainly changes the world around regulation by rulemaking, but that doesn't mean long-term it's really a win for business.
And that was Catherine Judge, Columbia Law School professor, and of course, Wall Street Week host David Weston, who joins us on set now. And I'm so glad you did that interview. Fascinating to listen to because it's hard to untangle all the different implications that this could have. But you make the good point that it's probably good for lawyers.
Well, that's the most important thing, of course, that the lawyers
Yes.
get paid. No doubt about that. But this is the most important law in all of Washington, which is the law of unintended consequences, because the Supreme Court's been sort of on a campaign of cutting back on regulatory things, which includes Chevron, other decisions this term actually as well to really cut back on it. And they think that's going to help business. Actually, we had Ken Jacobs from Lazard on last week, and he said, look, as an advisor in M&A, I think it makes it more complicated because I'm not sure what the rules are.
That's exactly what my mind went to. What does it mean for example, the FTC? Because you're sitting here with a Capital One Discover deal where things have been extraordinarily silent, and then you have this issue with the Supreme Court and the Chevron doctrine. So how far does this go?
You know this world so well, Sonali. As a practical matter, if you're deciding on a deal and you go and you ask your advisors, how's it going to work? It increases the time involved, it delays things, and increases the friction, which actually increases the cost of the deal, if I can put it that way, because you may prevail ultimately, but you don't know when you're going to prevail or how much you're going to have to pay in the meantime. But most important, because I've been on the receiving end of this, if we delay that time when we actually put the companies together, a lot of mischief gets done.
Congress is still going to want to regulate, obviously. How will they deal with this, in practice? Are they going to have to explicitly specify the people that they want to oversee their rules?
Going to have to. Can they is the question, Matt, right? Yeah. I mean, that's also like the important question doctrine, which also the court's been dealing with. And that's a great theoretical point, but look at Congress, what it gets done and what it doesn't get done. To your point, Matt, it has to do it, but I'm not sure it can do it. And if it can't do it, it sort of doesn't matter.
So a lot of big questions to noodle on. At least got some answers with Catherine Judge. Who else do we have coming up on Wall Street Week?
Well, we're going to talk to Scott Bessent. You know, Scott is very much in the news these days because he's talking to former President Trump fairly regularly. We're going to talk to him about exactly what a Trump 2.0 economy would mean and what it means for business. He's got some pretty outspoken views on that.
All right, a lot to look forward to there. Our thanks, of course, to Bloomberg's David Weston. This is Bloomberg. Well, let's take a quick look at some stocks hitting highs this morning, and we start with Citizens Financial hitting a 52-week high after it was initiated at Raymond James as a market perform. Of course, it reports next week. It's going to be interesting to see how that one goes. We also have Republic Services hitting highs after it was raised to a buy at Truist Securities. That's good for about a 0.6% rally. And this was a high, and now it's coming back a little bit. But you have Corning hitting a high earlier after its price target was raised to $50 over at Oppenheimer, but currently, Matt, down about 1%, I'll call it.
All right, interesting individual moves. Let's get to the trading diary, what you need to be watching this week. We'll get Fed speak from Raphael Bostic today at 11:15 a.m. Then at 6:30 p.m., President Biden holds a news conference as the NATO summit wraps up. It will be live. It is not scripted. It is a big deal, I think it's safe to say, for the campaign. Tomorrow, we get big bank earnings, really kicking off earnings season in earnest. JP Morgan, Wells Fargo, and Citi will kick off. Shanali is going to be coming in at 3:30 in the morning and spending the entire day here.
4:30.
We're going to get University of Michigan consumer data as well, so maybe one more piece for the Fed to ponder. But Shanali, what is the most important thing that you're looking for tomorrow?
Well, even the setup, right? You have a lot of the banks ended lower on the day, but now really taking their foot off the pedal, investors are here and starting to slip a lot of those banks back into green territory. Excitement around potential rate cuts coming into the market.
I have to say, I'm still more excited to see when the regionals really start going.
Yeah.
That remains the really important story for me.
I'm kind of excited not to have to watch all of them with that much closeness, but I am also excited
if you
for
get
them
the big
as well.
ones out of the way, then you can sleep until at least 4 or 4:30. All right, that does it for us.
Yeah, coming up, we have Bloomberg Tech. Technology, but that does it for Bloomberg Open Interest. I'm Katie, along with Matt and Shanali, and this is Bloomberg.
everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, Apple iPhone confidence, but regulatory risks. Details ahead.
Plus, Business Week's definitive story on Rivian's EV turnaround plan.
And a look at Neuralink and its competitors as Musk tees up a new implant. But first, let's check in on the broader tech index right now. Ed, I'm afraid that soothing of concerns around inflation has not driven up the tech stocks. Bond markets, yes, they are on fire, but today the Nasdaq is off by 1.2%. Some key players on the downside, Nvidia being one. But you're looking at other key names that are currently under pressure.
Yeah, Apple. And Apple is a big points drag. There are so many headlines out. In the first instance, with the stock at one point in the session, on track for its biggest drop since March, Bank of America up, raising its price target to $256 a share from $230, seeing confidence in a refresh cycle for the iPhone. Then there's the Bloomberg reporting that Apple has said to its suppliers, we want to boost iPhone shipments by 10%. There's some growing momentum around the iPhone story, up 18% or so year to date, but by no means one of the best performers on the Nasdaq 100. And then there's that bit you talked about, regulatory risk. Apple avoiding sanctions in the EU. Give me the details.
Yeah, I really think, though, at the moment, we are seeing this Apple concern at the moment, and the fact that EU regulators are basically forcing them to open up the wallet situation. The fact that we're seeing fintech being or eyes on the prize, maybe a boost to PayPal. But ultimately, this is the way in which EU regulators have decided that big tech needs to stop opening up their walled gardens. And Anurag Rana is exactly the person we should speak to about this Bloomberg Intelligence. And just dissect for us, Apple under pressure, big tech more broadly on the day. But as Ed articulates, there's some good mood music around iPhone supply and demand. But at the same time, there are these regulatory risks that are forcing business model change.
Yeah, Apple's performed really well over the last few months. And, if you go back in April, I think it's up, 35-40% since then. It's, the rebound has been driven a lot by Apple's AI story, which I think has resonated well with investors. Now, yesterday was probably the first big time news we got in terms of iPhone shipment improvement. And I don't remember in the last several years really looking at that kind of a news. And I think that really says that there is a lot of you could say hype/expectations about the iPhone 16 and what it could do to Apple's top line.
Anurag, the other big story is that Apple has avoided a fine from the EU because it's opened up its mobile wallet technology to others. It's made a concession. How do you think that impacts the iOS ecosystem?
Yeah, the Apple's CFO commented a few quarters ago that the App Store revenue from EU, accounts for about 7% of that particular area's sales. So it's really not that big of a deal, frankly. Now, this is nothing new. We are seeing EU really cracking down on all big U.S. firms. I don't think it's going to stop anytime soon. I don't think these cases are going to go away. But frankly speaking, from a financial point of view, it's not going to hurt them as much as, the headlines suggest.
Anurag Rana of Bloomberg Intelligence, thank you very much. I mentioned there were many headlines about Apple. Apple and Microsoft have dropped plans to take board roles at OpenAI in a surprise decision amid growing regulatory scrutiny. Here in San Francisco, Bloomberg Technology Senior Executive Editor Tom Giles. Give us the details of this Bloomberg reporting. Microsoft's investment in OpenAI is well known. But Apple was due to get a board observer role. Now neither of those are going to have a board observer role.
Yeah. Ed, OpenAI's board was starting to get really crowded with big, powerful tech companies, the most powerful tech companies in the world. That's a bad look when you are under regulatory scrutiny, when everybody is worried about a concentration of power and money around OpenAI, basically one of the biggest, if not the biggest LLM, biggest generative AI companies, was just getting too chummy with Microsoft and Apple. That was the concern.
A concern that actually is global, Tom. We were just talking how the EU has been focused in on Apple. They were focused in on Microsoft sort of ultimately doing a form of M&A here by stealth. Now, without the board seats, does that drive home that that isn't the case?
So Microsoft is the biggest investor in OpenAI to the tune of $13 billion. It's a massive investment. Microsoft is weaving OpenAI's technology into a lot of its own products. Apple is doing the very same thing. It's not an investor to that degree, but it is using OpenAI's technology throughout its software to make it basically to get people to spend more time on their iPhone, to make the iPhone more useful. Both of these things are basically showing how important OpenAI is and how important the relationship is with big tech companies that want to get a piece of the hottest generative AI property in the world. And that's where regulators are having a hard time. They're worried about competition. They're worried about other companies getting access to this technology. They're worried about concentration. And this is where you're seeing it start to come unraveled, removing those board observer roles for both of those companies.
And even that might not be enough. Sources telling Bloomberg that, regulators here in the US will still look at Microsoft because they're like, you didn't notify us in advance about this deal. Bloomberg's Tom Giles, who leads our technology coverage around the world. Thank you so much. Sticking with big tech, we're also watching shares of Google and HubSpot. Google down, Alphabet, the parent company, of 2%, HubSpot up 0.9%. The reporting that Alphabet has shelved its interest in HubSpot, a story we've been tracking here across the newsroom. Caro, what's up next in the show?
Oh, a story that is beautifully written by none other than yourself. We're talking Rivian's race against Tesla. More on how the company is taking an alternative route to woo those Tesla customers. This is Bloomberg Technology.
It's time for Talking Tech, and first up, Leap Motors makes a deal to go global. Stellantis has partnered with the little-known Chinese EV maker, investing $1.6 billion for a 21% stake. The joint venture would allow Stellantis to access Leap Motors' advanced tech features, while allowing Leap Motors to build and sell their cars in Stellantis' global network. Plus, Lucid Motors says they're still continuing to raise cash. Bloomberg spoke with CEO Peter Rawlinson earlier today.
This is a capital-intensive business, and we do need to raise more money, and we will at opportune moments in time on the future. Our vision is to be a major player here.
The company has license deals with the likes of Aston Martin and said they're in discussions with others. And auto plants get a lifeline. The Biden administration's awarding $1.7 billion to retool at-risk or shuttered manufacturing and assembly plants across 8 states, converting them to support EV manufacturing. The funding's being made available through the Inflation Reduction Act and is subject to negotiations and other reviews before becoming final. Karen.
Look, we are going to stick on this EV train. Ed, yourself and Mr. Max Trafkin are out with a really in-depth piece on Rivian and VW's partnership, what sparked it, how the EV maker is basically banking on the anti-Tesla crowd. And Ed, just walk us through who you first spoke to. There's this particular, well, sort of person we hear from who sums up how a lot of Tesla people and owners feel right now.
You know, actually, we spoke to many of them. There's like this great body of former Tesla fans, fanboys, owners, you know, that community online that's basically defected to Rivian for lots of reasons. And like, I think Max would agree, it's not very difficult to find them, is it, Max? You know, this was one case study. We spoke to several of them. The point being that that was Rivian's original audience. It's their audience now, and they got a lot to do, right?
Yeah, and what you see when you talk to a lot of Rivian owners, it's interesting because it tells you a lot about where the EV industry is going, and maybe also where Tesla is going, or where Tesla has at times gone wrong. It's not that these people are necessarily big Tesla haters. They're not the folks on X who are talking about shorting the stock or anything. They are just often just car people who are interested in EVs, much more interested in EVs, say, than in robo-taxis or wild promises about brain implants or whatever, and also interested in new models. I mean, and when you look at where Tesla has arguably made some mistakes and where Rivian has done well, I mean, I think if Tesla comes out with a Cybertruck that looks something like the Rivian R1T, which is their pickup truck, I think it would have been a much more successful launch. And so it's an interesting sort of crossroads situation.
I really wanted to do this story, Caroline, because I've covered Rivian for many years, and I've never had an experience in my career where a company has gone from like such euphoric highs to like really down in the doldrums, right? This was the 6th biggest IPO in US history. The biggest since Facebook. And now the stock would make you think that it's like a Fisker or a Lucid. But to their credit, like Rivian's a different beast, Caro. They actually make EVs. What we wanted to do is explain how they're going to get to that next stage, which is to get nearer to Tesla.
I like that. They actually make EVs. And Max, to that point, though, they haven't been producing them at the rapid clip that many thought. And, well, they have got a new prototype that actually is just a prototype. When are we going to get the R3?
Yeah, you have sort of two situations going on. One is just that car manufacturing is difficult, and we've seen this with many of these automotive startups. It takes them longer than they want. Rivian also faced a lot of supply chain challenges, especially during the pandemic. The thing is with EVs, right? They're selling a lot of these very expensive SUVs and pickup trucks. They are getting really good reviews, but the truth is, and RJ Scaringe, the CEO of Rivian, spoke to Ed and I about this, but like there's just a limited number of people who want these things. What the industry needs and what climate advocates need is more affordable cars. And Rivian is trying to get there and get there as quickly as they can. We have they're working on the R2, the factory in Normal, Illinois, that's central Illinois. They're really starting to get ready already. When I was out there a few weeks ago, and the long-term plan is this R3, which is, again, this kind of like almost mythical at this point, cheap electric car, the electric car that everyone can afford. But it definitely is a long way from being real.
Well, it's also like they're running out of cash, and I think that one of the important points that we make in the story is some of the reasons why they pivoted to Illinois, right, Max? And that is they were running out of money, partly because, according to our sources, the DOE said if you want some of this money from the Inflation Reduction Act, you have to change your position on unions, and we understand that that's just not happening right now.
Yeah, you had this frantic scramble. I mean, the weird thing is Rivian, of course, has lots of cash. It's just that the automotive, that making cars is so expensive that they're burning even more. And it was looking, as we wrote in the story, increasingly unlikely that they were going to be able to open this plant in Georgia. Ed, as you said, looking to the Biden administration, to the federal government, like many companies, and, ultimately not getting there. As we report in the story, these negotiations are ongoing. It's possible they will reach some sort of deal. But in the meantime, this VW infusion is huge for Rivian. It takes a lot of the pressure that this company is on. And of course, that's why the stock, went way up when the deal was announced.
And I love how we end on stock. We started on stock, and one of the greatest pieces that you have out of there is how the main owner of Tesla says there's two types of Tesla owners, those who are the stock owners and those who actually own the cars. All of this is such great reporting from both of you. Thank you, Max Chafkin and, of course, Ed Ludlow, just across the RJ Scaringe story. Coming up, well, we're going to be talking to Lin Chao, CEO of Fireworks AI, to discuss the future of AI and the company's plans following their most recent $52 million Series B funding round that really drives higher their valuation. This is Bloomberg Technology.
Okay, today for our AI in Action segment, we're joined by Lin Chao, who's the CEO of Fireworks AI, to discuss the company's latest Series B funding round, $52 million, but also their plans for the future of AI. So Fireworks is interesting to me, Lin, and welcome to the program. You describe yourselves as lightning-fast inference platform. So in the first instance, the basics of what a lightning-fast inference platform is.
Definitely. Thanks for having me here, Ed. In Fireworks, we have delivered one of the fastest and most cost-efficient inference engine using our proprietary technology. By that, we want to address the challenge of many applications, they require very low latency to drive responsive product experience and very low cost to deliver viable, sustainable business. And it's very difficult because large language models are big. So deliver all those requirements are really challenging. And here we focus on helping those applications to get there.
This is something that is targeted at both developers but also potentially enterprise customers. So if I were one of those two groups, a developer or running a large enterprise, how would I use Fireworks? Give me some examples or case studies.
Yeah, we have many customers ranging from leading startups to Fortune 500 companies using Fireworks to disrupt the status quo. And the startups using Fireworks to drive iterative, new creative ideas, and digital native companies using Fireworks to deliver new product experience. Fortune 500 companies use Fireworks to drive productivity. We have leading AI startups like Cresta, Cursor, SourceGraph, Liner.
Right. We're seeing some of your clients now. We're seeing actually some of your investors as well. I mean, this is a who's who of not just VC, but of strategic investors. NVIDIA's in, AMD's in, MongoDB is in, Lynn. How was the fundraising experience?
Yeah, we are blessed to be supported by so many, like the industry-leading investors of Sequoia. We also have investors from NVIDIA, AMD, and MongoDB joining force. We plan to use this funding to significantly invest in the following areas. Number one, to expand our inference offering and our ecosystem. To expand into the best and latest hardware provided by NVIDIA and AMD.
Right.
And build much tighter integration with vector database and database management systems, starting with MongoDB strategic partnership.
We're actually looking at sort of how the system works a little bit right now. Just going back to your affordable, basically, generative AI production platform. That's basically what you are. You're a production platform. You're helping companies use generative AI. But what I like is the fact that you think that generative AI's future isn't in large language models, not these massive closed source ones, but actually think it's about open source models, smaller ones, finer tuned. What is the future of compound AI systems?
Right. So we started from a large language model because the large language model are very powerful and magical, but those single models are not sufficient. As we're surrounded by rich content, as we're having this interview and conversation, we actually use audio and the visual information. In Fireworks, we want to use the new funding to make a big shift towards a compound AI system that can orchestrate across multiple single models with various different modalities and then AI tools to reach, for example, the latest news from Bloomberg or my personal calendars or personal to-do list and build the totality of a great application experience.
I think it'd be really beneficial to our audience to explain how different it is building on an application specifically in the inference domain relative to the training process of a large language model. I think a lot of what Caroline and I have focused on in the last 2 years or so is everyone everywhere building large language models, or other words, training the model on specific data sets. So what's that experience been like for you as you've built Fireworks?
Right. So we are hyper-focused on inference for the following reasons. Because most of the Gen AI technology, they are going to power a consumer-facing or developer-facing application. And those applications has a lot of users. And when you scale your product, that means you're going to quickly scale your business and your inference costs will also quickly scale. So scalability, reliability, and maintaining very expensive models in production in a reliable way is very important. So we predict that market is going to create a huge amount of expense, and that's where the enterprise is leading into to solve inference problems.
Lynn Chao, CEO of Fireworks AI, on the latest funding round. We thank you for your time. Now, earlier at Bank of America Breakthrough Technology Dialogue, Bloomberg caught up with Bijal Somaiya, partner at Lightspeed Venture Partners, to discuss, AI and capital markets. Take a listen.
What we're obviously seeing, and I think we would have anticipated seeing, is API call pricing coming down. Now, I think the most dangerous, our perspective is perhaps the most dangerous perspective to have at times like this when technologies are changing so rapidly is to think that we know what the answer is going to be. We don't, right? But here's what we believe, which is that in a world in which the volume of calls expands exponentially, which we will see as more and more enterprises adopt generative AI. And now if you think about an agentic world where each of us may have multiple agents operating on our behalf, and enterprises will have agents operating on their behalf, also making calls, well, then the volume of calls that are made on these foundation models is going to be absolutely massive, right? And so while the price per call may come down, the volume of calls will be extremely high, and we expect compute costs to decline. And so I would argue in that world, these companies at scale will absolutely be able to make a profit, right? But we don't know. These are things that we don't know, but I think it's dangerous to be too rigid with a particular point of view, and we're remaining open-minded about all of these possibilities.
Is there pressure that you put on some of these companies around monetization? Are you getting to that point where you're having those conversations? You need to start monetizing some of these products.
Well, look, I think these founding teams recognize, given the cost of compute and the capital intensity of these businesses, there's only two ways you can manage the capital intensity. One is you will keep raising capital. The other is you've got to earn revenue. And I think the answer will be both. You can't rely on the capital markets. The private markets have embraced these companies so far, right, with these companies raising billions of dollars, and most recently XAI raising close to $7 billion. So capital is available. But you can't assume that will always be the case, and I think we're beginning to see companies like OpenAI and Anthropic begin to scale revenue very fast.
Okay, interesting. In terms of the venture capital world and the structure within that sector, so Lightspeed's done something really interesting, which is looking at this continuation fund, so essentially allowing investors to take about $1 billion of stakes in your portfolio companies, so freeing up about $1 billion across the portfolio. It's a PE-style structure. What is the rationale behind that?
Yeah, the rationale behind that is that companies are staying private for longer. And at the same time, we want to be able to support those companies, yet recognize that some of our LPs that are investors in the funds that are invested in those companies, it's important to drive liquidity back to them. And so how do we solve both of those problems? Well, it is, for example, to take a set of what are still very healthy companies that are compounding in value and put them into what we call a continuation vehicle, where the underlying LP base may change, right? That provides liquidity to LPs that want it. Others may not, and they can roll over. And it enables Lightspeed to continue to steward those positions and continue to be a partner to those companies.
Coming up, we discuss AI and the brain, Synchron CEO, and how the company's brain-computer interface is using OpenAI's tech. This is Bloomberg Technology.
Welcome back to Bloomberg Technology. Ed Ludlow in San Francisco.
Caroline Hyde, right here in New York. And Ed, we had some big macro data today. CPI cooling once again, that inflationary pressure dialing back. But it is not good news for stocks. Sure, money pours into the bond market as we start to anticipate, could it even be 3 rate cuts this year? But we're down 1.7% on the bigger benchmark NASDAQ 100. Why? I mean, largely because we've got big tech selling off. NVIDIA, Apple, Alphabet, I mean, who's who of the big tech candidates. Maybe we're seeing profit taking at this moment. Maybe you're questioning valuations. Just remember, New Street Research put out a note but yesterday saying maybe we do think that we're fully priced in at these levels for NVIDIA, for example. But move on to some of the individual movers. TSMC actually down almost 3.5%. This after they hit a new record. Remember, $1 trillion company, 8th biggest in the world. Their numbers showed 40% growth in the previous quarter. But once again, maybe we're seeing some profit taking for TSMC. Netflix, we've got earnings coming up. Citi getting a little cautious ahead of those numbers. Tesla off by 0.5%. It had almost an 11-day running streak. And Musk has more on his mind, it would seem, Ed, at the moment too.
Yeah, I mean, it's Musk all the time because of all of the companies that he's at the helm of. One of them, Musk's brain computer startup Neuralink, aims to implant its device into a second human patient in about a week and to have devices in a few more patients by the end of this year. That's all according to a video update we got from Elon Musk yesterday. Joining me on set in San Francisco is Bloomberg's Sarah McBride, who does a very good job of keeping across not just Neuralink chaos, but I would say brain implant-related technology stories. I mean, that's the news, right? That they say they're making progress towards a second patient.
Yeah.
But what else did you learn in the presentation?
Well, it was very interesting. When they implanted the first patient, it went wrong a little bit. Some of the threads started retracting from his brain. So to me, the most interesting thing was the steps they said they would take to mitigate for that. So one of the things they're going to do, for example, is implant the device more aligned with the curvature of the skull. And they're going to try to place the threads that drop down from that device in a more targeted way in the brain tissue, and they're going to implant them deeper.
This was kind of classic. It was classic Elon Musk related company stuff where he's like on X, the platform he owns, and saying, oh, by the way, we're going to go live in 5 minutes.
Right.
And he had this team of people in like a conference room.
Right.
Who were some of those people? I guess we're not as familiar with Neuralink as we might be with SpaceX and Tesla on those other important people around him.
Right. So he had a team of 4 execs with him. Sitting immediately to his right was Dr. Matthew McDougall, the chief surgeon at Neuralink, who kind of, I'd say, gave most of the updates. And to the right of him was DJ Seo, the president of Neuralink. He's recently been promoted to president. They also had the person in charge of software and also in charge of the brain implants devices themselves.
Sarah, there was the mixture, of course, of short-term, practical use cases of brain injury, spinal injuries, enabling people to use phones and computers. But then there's the long-term. And then there's the brash Elon coming front and center once again. What do you say? It's to mitigate the longer civilizational risk of AI. Can you articulate why he thinks Neuralink is the path for that?
Well, his idea is that AI could end up being a malevolent force, and so our brains will need augmenting to combat that. And if you put implants in our brains, we'll kind of have superhuman powers. He's talked about how we might be able to communicate wordlessly or just download languages essentially into our brains, and he thinks those types of superior functions will help us fight AI if we need to.
Sarah McBride on the latest. And in fact, we now want to talk about the fact that there are competitors in the space. Sarah McBride has been writing about one, of course, when it comes to neurotech. And the Neuralink rival is Synchron we're going to talk about. It's just announcing that it's actually partnering more with AI, tapping OpenAI's newest technology to really help paralyzed patients communicate by using their brain device. Here for more is Synchron CEO Tom Oxley. Tom, it's great to have you in the studio. And sometimes, I imagine, it feels as though Neuralink takes the oxygen out of the room when it comes to these neurotech devices. But you have got 10 patients using yours. And how is OpenAI's integration going to be helping them?
So the idea of a BCI is that you can help people who are paralyzed, who can't control their bodies, to express themselves. So the problem with paralysis is a lack of autonomy, and it's a problem in medicine that hasn't really got many treatment options. If you're paralyzed, you do rehab, and there's not many treatment options. So huge unmet need, massive potential for a large market to develop. So it's exciting. I think Elon focusing on this field is great. I'm not sure about that future vision around, the idea about fighting AI. I think there's a much more important shorter-term use case to help a massive medical need. And so we're very focused on applications that are going to improve patients' autonomy. And so when the ChatGPT 4.0, the multimodal GPT came out, we realized that this was a huge ability for patients who lack the ability to engage in the world to improve both inputs and outputs with the system.
How can you give us explanations of how GPT 4.0 is going to enable those that can't usually communicate, interact with what's happening around them in the room, for example?
So the multimodal, it takes inputs from text, from vision, and from audio. So multimodal inputs, and then it can use all that to generate prompts that enable the users. In our case, we can use our hands to interact with prompts. In patients that are paralyzed, you can't engage with prompts. So we took the opportunity to build into a chat feature, which we've just released a demo of today, where the multimodal GPT generates a language prompt for our users. So that's the input. The output is the selection of the prompt to then generate a next action. But the BCI sits in the middle. The BCI sits in the middle. The BCI represents your ability to make a choice. And that's what you lose if you're paralyzed. You lose your ability to engage and make choices. You become dependent on other people. So the BCI is a digital representation of what you want to do. And the future of the link between BCI and AI is how the direct link from the brain to make selections with prompts lets you engage with the digital world.
Tom, it's good to see you again. Caro, Tom and I were on stage together a couple of months ago in San Francisco, and you were talking at that time about the progress that could be made with your different delivery system, right? So Neuralink is straight into the brain through the skull. You guys do this through the cardiovascular system. What has the LLM unlocked in terms of your cadence of putting it into the real world? That was something I was fixated on with you when we were talking.
Yeah, so there are advantages. So there are really, we see two approaches of getting into the brain: cutting open the head and going in with cables, or coming in through a blood vessel using a stent-based procedure. And so that's how we're differentiated. We think this is going to be the natural solution in medicine. There's many examples of minimally invasive approaches scaling into market, stents, pacemakers. And critically, the infrastructure to deliver at scale already exists, and we think that's going to be the natural progression of this technology. The challenge is that we don't have as much information coming out of the brain. So the key has been, how can we use the information out of the brain to deliver navigate and select, which is basically how you control a platform. So we have a interaction method which delivers navigate and select. We're using that Apple iOS accessibility platform to deliver that, and now we're infusing LLMs such as multimodal ChatGPT to allow our users to make choices interacting with prompts in a way which is amazing. And so Mark, one of our users in Pittsburgh, has been using this system, and we just released a demo today of how he's using it, and we're really excited about using especially how OpenAI are going to be moving forward with their new programs. Bringing in video as an endpoint into their API is going to be very exciting for our patients, but that's going to be the future. AI for knowledge and selections, BCI for expression of intent.
This is beyond hard, complicated, and expensive. Are you looking to raise funds? Do you have a healthy pipeline of people interested in backing and expanding your project?
We're very lucky to have investors that we're excited about, Kozler and Arch Ventures and Bill Gates and Jeff Bezos. We have decent runway for a little while, but we'll be looking to raise shortly.
Synchron CEO Tom Oxley, thank you. Caroline, I want to bring you some breaking news from myself and Dana Hole. Tesla plans to delay the unveiling of its robo-taxi or its robo-taxi day until October. You'll remember, Caroline, that it had been scheduled for August 8th, but what I'm hearing from sources and what Dana's heard from her sources is that they just want more prototypes. I'm actually also hearing that there's a bit of a rethink on the design and that this has all kind of happened in the last 24 hours or so. It's an interesting development. I don't really know what to make of it other than you see the stock there, Caro, moving down significantly. What does that tell you?
Sudden plunge that everyone had started to look at August the 8th. This was the fixation, wasn't it? When we got the delivery numbers that underwhelmed, the excuse coming from the street was that no, but everyone wants to think about what August the 8th means. What's the longer term vision, ultimately, of Tesla? Their share price run up ahead of this headline, Ed, has been pretty phenomenal. Last 10 days, we've added $40 billion in market capitalization, and suddenly we sell off. What an amazing scoop that you've just brought us.
Well, I've asked Elon Musk what's going on. We've asked him to come on the program, to comment on the story, etc. The big picture here is really interesting because the original thesis was when you buy a vehicle from Tesla, it comes with all the hardware and software you need for self-driving. So when your lease ends, either Tesla takes the vehicle back from you and they put it into a fleet, or the middle ground was that you can opt in to put your EV from Tesla into the fleet, much like you might put your home on Airbnb. But the third iteration that was outlined to us at the AGM was that they want to also do a purpose-built robo-taxi. So you'd have a combination of all three on what is a proprietary app, much like an Uber. The stock now down 4%. And I guess investors, to your point, are saying, well, this was supposed to be it. Like we were going to learn what the plan is, and now we might be waiting a little longer.
And we can now bring in one Max Chafkin, who races back to set to be discussing that this was the fixation of so many, not the Tesla owners, but the TSLA owners. A lot of those that particularly believe in the long-term vision is about robo-taxi vision.
Yeah, absolutely. And I mean, there were huge questions when Elon Musk said they were going to have this launch on August 8th. You know, there was, is it going to be an affordable car in the sense of a car you might want to buy? Is it going to be a robo-taxi? Is it going to have a steering wheel? Lots of questions like that. And I think investors were sort of just going with it, right? Because Elon Musk, as we talked about on this show many times, has a very good track record. And again, the reaction you're seeing from the stock is a reaction to the uncertainty. And if it's just a few months delay, probably no big deal. But I think there are real questions, profound questions about robo-taxis and how real this is in the near term. And then on top of that, you have questions about Tesla's ability to market cars, right? Well, what does this mean for someone who just wants to buy an affordable electric car?
Max, I'm just looking at the Bloomberg terminal. A decline of 5.5% for what it's worth is putting Tesla on track for its biggest drop since April 30th, now down more than 6%. So investors are kind of looking at this. I also want to talk with you about the kind of academic approach to self-driving. So Tesla has a vision-based platform. It does not use LiDAR or radar. But Kara and I were talking while you were running down the stairs to set about the idea that initially this was, if you owned a Tesla, that Tesla would end up in a fleet, much like you put your home on Airbnb, and then to our surprise they go to a purpose-built robo-taxi. So what do you make of the purpose-built robo-taxi bit? And I guess the delay is in part a lack of information about that strategy?
I think there are probably a number of things going on here. I mean, as we know from previous reporting, there has been a lot of tension inside of Tesla over exactly how this should go. I mean, Elon Musk, as he personally has made clear, believes in robo-taxis. I think there are many people inside of Tesla who like the idea as a vision, but are sort of more open to the skeptical arguments. The thing that I've thought all along, making this a somewhat unrealistic plan, is just that you have companies like Cruise and Waymo that have been working very hard and spending billions of dollars and making lots of, doing lots of work to negotiate with various local partners and so on. And they haven't gotten that far, right? Like Waymo doesn't have that many vehicles. It isn't in that many locations. It's going to be very hard for Elon Musk to just switch this on. And I think if you're talking about the trade-offs between a personal vehicle and a robo-taxi vehicle, that creates an additional complication.
as we point out, he often doesn't get it in the timeline he says he will, but he often gets there in the end with those products. Max Chafkin, thank you so much. Coming up, we're going to be joined by PitchBook VC analyst Carl Stanford to break down the company's latest report into the health of the VC ecosystem. That's coming up next. There he is. This is Bloomberg Technology.
Helsing is a European startup developing AI software for defense. It's just raised rather mammoth $487 million. It plans to use this new funding to expand its presence in European nations bordering Russia. Ed, what are you looking at?
I'm looking at all the things a Bloomberg anchor is expected to look at, Caroline. Global inflation, interest rates, macro uncertainty, because they've all pulled down global VC deal making. But in the US at least, it's not all doom and gloom, with deal activity increasing on a count basis for each of the past 3 quarters, a positive sign that deals are getting done. Let's break it all down with Carl Stanford, lead VC analyst at PitchBook. The data is so important, even if it's backward looking, Kyle, because we get a lot of the reporting each quarter about deals that are done, but then you see it in aggregate after the fact. Those 3 macro points, why in the US is there less pressure from them?
So I don't think that there is less pressure. When you actually dive deep into the data, what we're seeing now is companies coming back to market that haven't raised since 2021 or early 2022. And so the time that they spent, kind of kicking the can down the road for financing through layoffs, through slower growth, through extending their runway of their can, now they're coming back to market to raise. There's still a huge amount of dry powder in the US as well. We're tracking about 295 billion in dry powder that needs to be put to work. So there is equity deals getting done, which is a positive sign from an interest standpoint. But many of those companies are just now coming back to market and kind of inflating the number of companies raising at the moment.
So they've white-knuckled it. They managed to get through. How many of them have had to make themselves an AI-related play as well?
Well, we're seeing about 26% of deals being completed into AI companies, whether they are, true foundational models with LLMs or kind of vertical applications using OpenAI to do some sort of their business model. 50% of deal value as well. I think everything is pointing toward AI. If you're an LP, you want to get into an AI fund. If you're an investor, you want to get into an AI company. If you're a company, you want to somehow pivot to an AI business model. I think it's kind of the big talk of the market right now.
So we're showing US VC deal activity by quarter, backward looking and then 2Q. Extrapolate out about what you see for the rest of the year, Kyle.
Sure. The first thing I want to point out is that of that $55.6 billion, about $15 billion of it is from two deals. The CoreWeave, $8.5 billion deal, and then the OpenAI, or XAI, $6 billion deal, right? So this is really inflating the top line value. Where we see the rest of the year going is obviously going to be driven by any large deals that happen, but it's going to be continued to be relatively slow for the middle of the pack to the lower quality companies. I think what we're seeing now is high quality companies getting those deals done. If you look in the data, valuations look really high compared to really any year. But what is happening is those companies that raised on high valuations in the past are coming and raising again now. And if they're higher quality, it's boosting up that median value or pre-money valuation that we're seeing. It's not necessarily the market strength that it would actually portray from just looking at the data.
Kyle Stanford, always bringing us the latest and greatest in VC. We thank you from PitchBook. This is Bloomberg Technology.
President Biden is steadily losing support from a part of the country that knows image and stagecraft the best, Hollywood. Since the debate, heavy hitters including George Clooney, super agent Ari Emanuel, Netflix's Reed Hastings, and heiress Abigail Disney have all called on Biden to drop his re-election bid. Clooney is a lifelong Democrat who helped raise $30 million for the president at an event last month and said Democrats can pray for a miracle in November or they can speak the truth. Some in Hollywood are now even turning against media mogul Jeffrey Katzenberg, who serves as a co-chair of Biden's re-election campaign and is one of the president's top donors, who they say has intentionally shielded Biden's decline until now. Karen.
And onto the other candidate in the presidential race, Donald Trump. He's going to speak at Bitcoin 2024 conference. It's this month, and it's all according to the event's organizers. And it's going to be an address that would highlight, well, his growing embrace of the crypto industry. Let's discuss with Bloomberg's Sonali Basak. And we've got all of crypto Twitter talking that he's going to be at this event. And it does seem to be more and more of the Republican viewpoint that this is something to win on.
That has been a massive debate, and that is seemingly where things are coming off, especially when you've had such serious pushback here, not only from the Securities and Exchange Commission, but President Biden himself when it comes to certain aspects here. The Biden administration's approach to how legislation has been crossing the lines in Congress. And so remember, we're standing here at a moment where such little progress has been made on key stablecoin bills, for example, and there's a hope here that perhaps a change in an administration will really start to dilute some of the influence, some of the stronger voiced anti-crypto members of Congress have had. Think Sherrod Brown, think Elizabeth Warren. The idea here that a more Republican president, but also more Republican lawmakers in Congress overall, will really start to cause a dent in how the industry has been approached in the last 4 years.
It tallies with the reporting that we had that Vivek Ramaswamy, Musk, Trump, and crypto was the common point for the Sonali Basak. Thank you. Good show, Karen.
What a thick and fast show. Great reporting on Rivian and Tesla. Great breaking news on Tesla from you as well. That does it for this edition of Bloomberg Technology.
Recap it all in the podcast. We missed a few shows this week, but we are back from New York and San Francisco. This is Bloomberg Technology.
Welcome to Bloomberg Markets. I'm Scarlett Fu. We are seeing red on the equity screen today. The S&P 500 retreating from a record high, falling the most since April, even after a cool inflation report that paves the way for the Federal Reserve to cut interest rates. So let's get you a quick check on the markets right now. We're starting with the S&P 500. You can see they're losing 0.9%. This marks the first pullback in almost 2 weeks and a pretty meaningful decline at that. We're seeing a rotation out of some big cap growth names like technology, like communication services, like consumer discretionary into things like REITs, utilities, industrials, and materials. For the NASDAQ 100, which of course is made up of those big cap tech names, an even larger decline of 2%. All the Magnificent Seven names, for instance, are falling. And within the Philadelphia Semiconductor Index, a drop of 3.25% with all 30 names in the red. Now, what's interesting, of course, is part of that rotation going into the old economy names. The Dow Industrial is up by 0.2%. It is the outperformer here with names like 3M, Dow, Home Depot, and Caterpillar advancing. Let's take a look at the bond market, starting with the 10-year yield. It is hitting its lowest since March, and you can see that big intraday decline right around 8:30 a.m. when the CPI numbers crossed. We've seen U.S. Treasury auctions get pretty solid demand so far this week. If we switch it up and take a look at dollar-yen, again, an intraday chart, you can see a similar movement, of course, the inverse here. The dollar losing ground, of course, we're quoting this as Japanese yen, so the yen rising in value here, with the dollar losing ground against most major currencies. The slowing inflation data out of the U.S. this morning boosting the odds of a rate cut later this year. But the yen also stronger here on the back of large offers in the brokers market, as well as stop-loss sales. And that is increasing speculation about official intervention from Japan to support its currency. That's been a theme in the currency market for a couple of weeks now. Now, speaking of inflation, data showed that it cooled broadly in June, driven by a long-awaited slowdown in housing costs. So what does this mean for Fed policy? Joining us now is Yelena Shiliacheva. She is senior U.S. economist over at BNP Paribas. Yelena, thank you so much for joining us. Really appreciate your taking the time. The headline CPI number fell unexpectedly. There is a bit of whiff of deflation in the air. So let's just unpack the numbers as we got them. How broad was the weakness in pricing? We mentioned certainly housing was one component, but give us the overview.
Sure. So I think it's too early to worry about deflation here, of course. But I think there were two things that I would like to say about it. So first, there was some normalization in some very abrupt moves that we saw in the May report. So you mentioned housing, right? And housing was a very strange increase in housing costs in May, which normalized in the June report. But even, despite all these different categories normalizing, such as car insurance, for example, also normalized from a very strange decline in the previous months, it was a sense of a broad-based cooling, particularly in the services sector. So I'd say it's a very welcome development. We see that finally inflation is a lagging indicator, of course. It's finally starting to catch down to developments in the economy and in the labor market.
Yeah, we had already seen that slowdown take place in the goods. So to see it start to really take root in services is encouraging, certainly for the Fed. We know that Jay Powell told Congress this week that Fed officials need to gain more confidence before cutting. But confidence is qualitative. It's not quantitative. So to what extent does this morning's data point, the June inflation report at large, provide some of that confidence?
It will definitely boost their confidence. So, the labor market is where it needs to be, right? And probably even slightly weaker than the Fed would like to see. So if you simply look at the unemployment rate, 4.1% we saw in the June jobs report is already slightly higher than the Fed penciled into their June summary of economic projections. Today's data is tracking such that we may actually undershoot 2.8% year-over-year growth in PCE inflation that the Fed was expecting by year end. So that all obviously increases the chances of an earlier rate cut.
Okay, when we say earlier rate cut, does this data put a July rate cut on the table?
No, not too early. Too early. I think between now and the July FOMC meeting, there's simply not that much major data that could really push this forward. And I think the data so far in terms of the labor market and inflation is really something that the Fed would like to see to kind of like for them to proceed as they expected and start cutting rates later this year. I would say that, going in July would spook the markets and would just mean that the Fed is seeing something that we don't see. And that's not what the Fed wants to do.
Okay, so maybe they use the July 31st meeting as a way to signal that things are moving in line for a September cut. When the Fed does start cutting, Elena, David Rosenberg, an economist, says the first 250 basis points of the rate cutting cycle will mainly remove the excessive restraint as opposed to providing any real economic stimulus. What's your take on that?
I think that Powell will probably make a big announcement at the Jackson Hole meeting at the end of August. But in terms of how this will affect the trajectory of real interest rates, I agree. I think the Fed just needs to push nominal interest rates a bit lower so that real rates don't make more restraint for the economy. I think that's the key here. This cycle, this cutting cycle, it's not an easing cycle. It's a cutting cycle. And the Fed will need to do that in order to not over tighten, so to say. It will be different, most likely, from the past cutting cycles that were driven by weakening economy into a recession. So that's probably not what we're looking for.
All right, important distinction there. Yelena, thank you so much. Yelena Shiliacheva is senior U.S. economist over at BNP Paribas. Coming up, we're going to get a wrap on NATO because Richard Haas will be joining us to discuss the future of the alliance and the state of geopolitical tensions as everyone watches President Biden to see how he's faring at this summit. This is Bloomberg.
Is everything.
This is Bloomberg Markets. I'm Scarlett Fu. We're paying attention to the markets, of course, which are in the red right now after a cooler than expected inflation report. We'll get to that more later on, but we do want to talk about what's happening in Washington. NATO issued a declaration on Wednesday night calling out China's military support for Russia in Ukraine. The declaration described China as a decisive enabler of Russia's war against Ukraine. This, of course, as the campaign, Biden's campaign, fights an intra-party uprising over his fitness for office. Let's bring in now Bloomberg Balance of Power co-host Kelly Lyons with more. So, Kelly, just give us the big takeaways so far from NATO.
Well, certainly there have been some deliverables from this summit that's now in its third day here in Washington, Scarlett, including additional aid for Ukraine, which was announced by President Biden at the beginning of the summit on Tuesday. 5 long-range air defense systems, dozens of other shorter-range air defense, something that Ukraine had desperately wanted, and conversation as well around an eventual path for Ukraine to join NATO, though the conflict with Russia does need to be at its end in order for that to actually happen, considering allies would be inherently drawn into that active conflict if it were to happen in the near term. By and large, though, a lot of this conversation at the NATO summit has been dominated by questions around the presidency of the United States, not just who's going to win in November as allies brace for the potential return of Donald Trump and what that could mean for the U.S.'s relationship with the alliance and how the nature of it could change, but also just the acuity and ability of President Biden to be a leader of the free world at this time when so many questions are swirling around his age, which is why his press conference tonight, which we're expecting at 6:30 p.m. Eastern time, is going to be absolutely critical, as he is not going to be reading off a teleprompter. He is going to be thinking off the top of his head and ad-libbing answers to questions from the press. It's really hard to overstate how critical a moment this is for him, Scarlett.
Yeah, so no safety net for President Biden with the world watching. Of course, we also have more prominent Democrats coming out and speaking out, urging President Biden to step aside from the presidential race, including the senator from Vermont.
Yes, this one is critical because this is the first time we have seen a Democratic member of the Senate call for Biden to step out. But Senator Peter Welch has done that in a Washington Post op-ed overnight. And it's noteworthy that Biden campaign aides, some of the most senior officials, including the likes of Steve Ricchetti, this hour are set to meet with Senate Democrats to kind of try to stem the bleeding, if you will. Of course, while we've only seen one senator at this point call for Biden to drop out publicly, we have seen a number of members of the House, now up to 10, who have publicly called for him to step out. Just today, a frontliner, if you will, a Democrat from Michigan, Hillary Schulten, has joined the chorus. Earl Blumenauer called for him to drop out overnight as well. So they have at this point not proven that they've really stopped the bleeding. And there's a question, once NATO is over, what could happen then? Because House Speaker Emerita Nancy Pelosi on MSNBC yesterday not only declined to full-throatedly endorse Biden's re-election effort, saying it's his decision whether or not to stay in the race, she also encouraged everyone to essentially pipe down until NATO is over. And there's a question as to whether or not that was a signal to her Democratic caucus that they just need to be biding their time until all the pomp and circumstance is over.
Yeah, well, in the meantime, there's still a lot of pomp and circumstance to go. Bloomberg Balance of Power co-host Kelly Lyons, and of course, you'll want to check her out on Balance of Power later this afternoon and this evening. All right, let's discuss all of this now with former U.S. National Security Senior Director and President Emeritus of the Council on Foreign Relations, Richard Haass. Richard now serves as Senior Counselor at Centerview Partners. Richard, thank you so much for speaking with us today. As Kaylee just kind of gave us a rundown here on what was accomplished at NATO so far, we know that the alliance said Ukraine's future is in the alliance, and we will continue to support it on its irreversible path to membership. Can you translate that into plain English for us? What does that actually mean? What does that actual support entail?
Well, the support is modest. It's another, $40-50 billion in aid, some useful weapons, particularly in the area of air defense, which should help blunt some of the Russian attacks. Putting Ukraine on a quote-unquote irreversible path to membership doesn't really mean a whole lot. Not only is there no timetable, but it's not clear what the conditions would be. I think you and Kaylee were discussing a ceasefire. But what would be the territorial reach of a Ukraine that would enjoy NATO protections? How would that work? What kind of limits might be acceptable in terms of NATO weaponry or forces on Ukrainian territory? So I actually think the conversation about whether and when and how Ukraine might one day be a member of NATO has barely begun.
Who would have that conversation? Because President Biden and Emmanuel Macron of France both face uncertain futures right now.
No, you're absolutely right. They do, as well as the Chancellor of Germany to some extent. So look, it's a political military alliance, and it's hard for the military side to operate absent an equal political side. Plus, as you two were just discussing, there's the specter of Donald Trump hovering above all of this. So quite honestly, we could begin the conversations now, but until there's clarity, whether there's a government of France, more important, what is the next government of the United States, not just the presidency, but the Congress, I don't think these conversations amount to a whole lot.
Yeah. Is it possible for NATO to Trump-proof the aid to Ukraine?
In a word, no. NATO can't really Trump-proof anything in terms of aid to Ukraine, in terms pretty much of anything else. U.S. force levels in Europe, policies vis-a-vis Russia. Under our system, as you know, the President of the United States, the executive branch, really enjoys tremendous discretion and latitude when it comes to designing and implementing American foreign policy. So all this talk about Trump-proofing is really pretty much empty talk.
Okay. And of course, President Biden is not the only wild card here, meaning if he doesn't stick around through next year, because I think about Hungary's Viktor Orban also, in the mix here. OPEC name-checked China in its statement, accusing it of providing weapons parts and other technological support to Russia versus Ukraine. How united is this alliance against China at the moment?
Well, that was interesting. I actually thought that was the most interesting part of the NATO summit, the tough language about China. It's almost as if the era of kind of romanticism about China, which a lot of Europeans as well as Americans for a while were part of, that's passed. I think the interesting question now, Scarlett, is what actually comes from that language. China is violating the spirit, if not the letter, of all of its commitments not to arm Russia by giving technology and components. So what now are the NATO countries prepared to do? What will be the diplomatic and, more important, economic and military consequences of this surprisingly tough language? That doesn't seem to have been decided, but I would keep the focus in that in coming months.
Okay, so in terms of looking for follow-up action, we're more likely to see follow-up action on China than on Ukraine?
I think that's realistic. But again, a lot depends upon whether there's a will to match those words. Again, the first time I've seen NATO and the United States and Europe come together with such tough language, be curious to see how the Chinese react, whether they try to diffuse this situation, and if they don't, what are the United States and Europe actually prepared to do in terms of technology restrictions, market access restrictions, and the like?
All right, so the gauntlet has kind of been thrown, and we'll see how China responds. We know that foreign policy is President Biden's area of expertise. He was chair of the Senate Foreign Relations Committee for years. This event should really be Biden's moment to shine, but it has, of course, turned into a fitness test for him. What have you seen, what have you heard from Biden so far at this event?
Look, I think his speech has been fine. We'll see how the press conference later today goes. The communique was pretty much a standard NATO communique. I don't think it'll matter a whole lot, though, because, first of all, Americans are not focused closely or intently on NATO communiques or on NATO summits. It's not going to affect a lot of voting. And we'll see again. I think the press conference will matter more. But again, because of the debate, every time President Biden goes out now, people are sitting there wondering less about what he says than how he walks, how he talks, and the rest. And I'm not sure he can turn the corner on that.
Yeah.
And that's this larger conversation about whether he will step aside or remain the candidate is really the issue of the moment.
Absolutely. After the debate about 2 weeks ago, you wrote the debate and the growing perception that Donald Trump will win in November will turn POTUS into something of a lame duck with more than half a year left in his term. It'll work to diminish U.S. influence with friends and foes alike. What is your perspective on how NATO allies are likely viewing all this turmoil, all these questions about his age and his fitness?
It's incredibly disorienting for them. In large part, it's not simply because of Joe Biden, but taking a step back. In the good old days, NATO could look at the United States, and it didn't matter who won one of our elections. Whether it was a Democrat or a Republican, 99% of the policies towards Europe and NATO would be the same. what's such a departure here is what Donald Trump represents domestically, but more important, his foreign policy is so qualitatively different than the last 75 years of American foreign policy. It's so different from Joe Biden that this is truly disorienting for Europe because alliances depend upon reliability and predictability. And because of Donald Trump, the United States is no longer in the business of being reliable or being predictable.
Yeah, the stability simply isn't there. So I guess just to put it bluntly, Richard, do you believe President Biden should stay running for the president in November?
As I said publicly, I do not. I think he's been a good president. I think he's a really good man. But I do not think he can defeat Donald Trump, part because he's an incumbent. It's a bad moment to be an incumbent that we've seen in all these other elections. In part, his age issue makes him the issue and not Donald Trump. And I think so long as he is the issue and Donald Trump and his policies are not the issue, I think then Joe Biden loses. So I think for that reason, as well as the fact how demanding this job is, the idea that this Joe Biden could do the job in 4+ years when he's 86, that's a stretch to be generous. So I think if you want to see Donald Trump not return to the Oval Office for a second term, I do think it's incumbent upon the Democrats to find somebody else. And I think Joe Biden should step aside for the sake of his legacy and for the sake of this country.
Thank you for answering that, Richard. Last September, you moved over to join the investment bank Centerview. So I want to get from you your advice to CEOs perhaps looking to make big acquisitions right now. What is the single biggest geopolitical risk that they may be underestimating right now and should consider before going forward with a big acquisition?
I think the biggest short-term geopolitical risk is what we've just been talking about. It's the uncertainty about the role of the United States in the world. We have been such a linchpin of order in the world for the last 3/4 of a century from our entry into World War II. And you can't take that for granted anymore. And I think for the people in the business world, they've got to assume a greater degree of uncertainty. Then you've got the fact of these emerging powers, much greater turbulence in the world. And on top of that, the world hasn't come together to deal with various global challenges, beginning with climate. So all things being equal, it's a fasten your seatbelt time. That going ahead, it's going to be a much more difficult environment, literally and figuratively, for business people to navigate than what they're used to.
All right. Well, thank you so much for sharing your views. Richard Haas, Senior Counselor at Centerview Partners and, of course, President Emeritus of the Council of Foreign Relations. Coming up on Bloomberg Markets, with inflation top of mind for consumers and companies, we're going to hear from the CFO of General Mills on their strategy to keep shoppers coming back. This is Bloomberg. Consumers are fed up with inflation at the grocery store, and that has been a challenge for CFOs like Kofi Bruce of General Mills. A new season of Bloomberg's Chief Future Officer begins this week with a focus on one of the leading packaged food companies. Our Romaine Bostic spoke with Bruce and the CEO Jeff Harmening on these inflationary pressures.
We've had a period where we've gone through once in 50-year inflation, right? It's impacted our cost structure. We're up almost 30% in our cost of goods sold just over the past 2 years. If I dial back to the beginning of the pandemic, almost a third increase in our cost base, almost $3.6 billion, give or take.
The consumers are feeling the pinch of inflation. So even if inflation is coming down, that doesn't mean it's deflationary. We're in this dichotomy where in some ways we're settling into a new normal, and in other ways it feels very abnormal and very stressful for consumers.
From 2020 through the early months of 2024, food prices soared 25% in the U.S., well above the 20% rise for consumer prices overall. Food inflation concerns dominated headlines.
Every time Ohioans go to the grocery store,
the Senate held hearings on shrinkflation, calling out industry players for reducing the size of their products without actually reducing the price. It's a challenge many companies have had to address.
There's been a lot of talk about shrinkflation among a lot of the packaged goods companies. How do you go about creating a more cost-effective, both for you and for the consumer, but doing it in a way that's a little more transparent?
We have to do the things first that dampen the impact, right? That don't impact the consumer. If we do our job right and we're driving productivity, that takes some of the sting out because that's costs that we don't have passed back certainly ultimately to the consumer. But the other job is to make sure that if we've got consumers that are looking for value, that we're hitting them with the right promotions and the right incentives, as well as we've got pack sizes to kind of meet their price point expectations. That's a big part of the job.
All right, coming up, we talk real estate with Samantha Rudin-Earls. This is Bloomberg. Welcome to Bloomberg Markets. I'm Scarlett Fu. Let's get you a quick check on the markets at midday right now because the S&P 500 and NASDAQ are falling the most since April. You can see declines of 1.9% for the tech-heavy NASDAQ 100, down 0.8% for the S&P 500. And this is after a fairly cool inflation report. This was an instance of buy on rumors, sell on news, given that the indexes had gained for 7 days straight prior to today. You're also looking at yields going down for both the 2-year and the 10-year. There have been a couple of auctions so far this week, which have seen favorable demand. But of course, the big story here is that slowing inflation does give the Federal Reserve room to move forward with interest rate cuts later this year. Now, speaking of interest rates, let's turn to real estate because higher for longer rates for the past 2.5 years has made commercial real estate a real source of concern, including for Fed Chair Jay Powell. Bloomberg's Abigail Doolittle is here now, along with Samantha Rudin-Earls, co-CEO of Rudin, which manages 17 residential buildings and 15 commercial office buildings here in New York City. Let me start with Abigail, who has an overview for us on where the real estate market stands right now. Abigail?
Well, Scarlett, one of the big stories, of course, is the world of pain that commercial real estate is in. But it's not all sectors within commercial real estate. Office in particular, a lot of pain coming out of the pandemic, people still working from home, so higher vacancies. And you can see this really weighing on some of the publicly traded office REITs, SL Green, Vornado, which is actually the owner of the building that we are in, and then Boston Properties. Big declines over the last 5 years as those publicly traded companies, those investors have had to be pretty disciplined in terms of the balance sheet and take the losses. That's not necessarily true with a lot of the other office buildings out there. We're all waiting for some sort of move down for office properties, but not a lot of activity in terms of trading. Let's take a look at the delinquency that we're seeing because a piece of the story, of course, is this big wave of CMBS that's expected to hit $1 trillion, $1.5 trillion by the end of next year, some are saying. Coming out of the GFC, we did have delinquencies on CMBS going up toward 10% in, let's call it 2011, 2012, and then down as rates went lower. Well, now we're creeping back up to 6%. But it's not all painful. There's other sectors that are good, but the office part of it, at least, Scarlett, bad enough that we did, in fact, this week here, Fed Chair Jay Powell address concerns around commercial real estate. Let's take a listen.
This is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk.
Let's now bring in Rudin co-CEO Samantha Rudin-Earls. Thanks again for joining us. And that was a great overview from Abigail. I'm curious to hear from you on the 17 residential buildings and the 15 office buildings that you own. What have you seen? What does it look like for you?
Well, thank you so much for having me. And obviously on the office side, there's been it's been a lot of distress in the office, but we're also hearing, the chairman, Powell talk this week and knowing that as inflation starts to cool and the labor market is softening, the potential of rates coming down in the fall would be very helpful on the office side. But I think it's also really important to focus on while there are areas where office is struggling, there are also areas where office is doing really well. If you look at Park Avenue, the vacancy is sub 8%. We recently just renewed and expanded a lease with Blackstone for over 1 million square feet. And you see in the office market, again, a flight to quality, a flight to amenitization, buildings that are located in good locations next to mass transit. And so it's not, the story is not all bad in office, and hopefully as, rates start to come down, things will start to move more and everything will improve. So we're looking forward to that.
That's really encouraging to hear that it's not all bad. And we've heard that from some other folks who have joined us, that Class A and some of the prime areas, that they really are doing well. So we're glad to hear that that's the case. But something that we keep hearing about is the idea that there's this glut of office, maybe some of the B and C that can be converted converted to residential. And I know that you recently sold 55 Broad, but you're still involved, and that is being converted to residential. And you're excited. You're the first person I've heard being excited about it. So talk to us about that.
Yeah, well, obviously with the, surplus of office space that is in buildings that are, could be repurposed because they're no longer serving as an office building. And in the financial district, conversions have been happening for over 30 years. And, since the 90s, it went from 10,000 people living in Lower Manhattan to now 70,000. And we recently sold our building at 55 Broad Street to Silverstein and Metro Loft, and they're currently converting this building that was built in the 1960s to a 571-unit residential state-of-the-art apartment building. It's going to have a full suite of amenities, wellness, and there's going to be a pool on the roof deck, and they really found a way to effectively repurpose this, office older building and make it into, beautiful market rate housing.
And Nathan Berman, of course, is helping out there, considered to be the maestro and creating that there's not a doom loop down. But let's stick with residential because that's really your area. And so when we spoke a few weeks ago, and thank you so much for joining Scarlett and I, we really are so happy about this. When we spoke, you talked about the idea that your occupancy right now is at an all-time high for residential, and yet we keep hearing about this inflation, these prices. At what point are New Yorkers going to push back where they're not going to keep paying record high rents and keeping occupancy at record highs as well?
Well, I think the problem is that there's just a real shortage of supply. There's no, vacancy throughout the city is 1.4%. So the fact that there's just not an supply of housing makes it that, and we, we're a long-time owner here. We have 17 residential buildings, 15 office, and we really pride ourselves on investing in our properties, and we've used this period of time where the demand is so strong to reinvest in our properties, continue to amenitize them, modernize them, and we're hoping and we see the long-term value of New York and obviously multifamily.
You mentioned investing in your properties, but there are certain things that are beyond your control, like public transit. The MTA, of course, now has some money issues, and they have to defer $16.5 billion of capital upgrades because this city and the state are not moving forward with congestion pricing. How do you work around that, given that this is something residents and buyers have to consider, the access to public transit?
Yeah, no, it's a huge issue, and hopefully, congestion pricing can somehow get reworked because it would really be a huge, it's really important that our transportation system functions right. It's essential.
Well, Samantha, I just have to also mention your family because the Rudin family, of course, is a storied New York family. And I know that your grandfather started the company about almost 100 years ago. Next year will be your 100-year centennial anniversary. So what do you do? Because I know that you do so much to really help the city, preserve the city. We came out of the pandemic. We seem stronger than ever. What are the things that you are really focused on right now?
So our company is about to celebrate its 100th anniversary in 2025, which is a huge milestone for us. And, all of these shifts in the market and cycles, the upturns, the downturns, we've been able to ride through them for the last, 100 years. So we take a long-term outlook on the city, and we also see the importance and value of constantly giving back. And my family has believed that if the city doesn't do well, if the city's not doing well, then it will have an impact on our business. And so we give back to whether it's hospitals, schools, parks, the arts, all different organizations to help infuse the fabric of the city. And we see that as, what is really important for the long-term success of New York City.
All right, Samantha Rudin Earl, and she is the co-CEO of Rudin Management, and Bloomberg's Abigail DeLittle. Thank you both so much.
Thank you.
Really appreciate it. Coming up, we're looking at shares of Tesla. They were on a tear in recent weeks, but a new Bloomberg report is sending the stock plummeting. A quick check also on where stocks stand overall. We're seeing selling pressure on the S&P and the NASDAQ today, with the NASDAQ off by 1.5% on pace for its biggest decline since April. This is Bloomberg Markets. This is Bloomberg Markets. I'm Scarlett Fu. The Biden administration is giving out $1.7 billion to retool U.S. auto plants for electrification. This grant affects facilities across 8 states and is part of a program from the White House's signature climate law, the Inflation Reduction Act. President Biden has set a goal of having 50% of all new vehicle sales be electric by 2030, as well as bringing back domestic auto parts production from foreign countries. Now, speaking of EVs, some of which is made in the U.S., that brings us to our stock of the hour, which is Tesla. Bloomberg reporting that Tesla plans to delay its robo-taxi unveiling till October. We saw the shares turn sharply lower on the news. Prior to that, Tesla stock was on its longest winning streak in years before this report came along. Let's bring in now Bloomberg Technology co-host Ed Ludlow for more from San Francisco. So Ed, this robo-taxi, which has been talked about for so long, has really become the focal point for Tesla investors, and this idea that Tesla stock can recover from its stumble over the past month, over the past year.
Yeah, and that probably speaks to the severity of the decline after we published that report. So what Dana Hall and I are hearing from sources at Tesla is that they're basically just not ready. They wanted more prototypes of this purpose-built robo-taxi to show at the event. It had been sort of loosely scheduled for August 8th because Elon Musk had posted on X that it would be August 8th. It's delayed by 3 months, which doesn't seem like such a big deal necessarily, or a couple of months. But what we're hearing is that's the impetus here. They want more to show for it. The stock, I mean, down 6%, that seems like a lot. But because at the heart of the bull thesis is the idea that autonomy and an almost Uber-like service is a great proportion of Tesla's future revenue.
And this has really been something that Elon Musk himself has chosen to focus on, as opposed to talking about Tesla's production numbers and the fact that sales have been cooling off. And this has been driving the stock's 11-day rally.
Yeah, and the other day he responded to a user on X who was responding in kind to the Tesla second quarter deliveries, and Musk basically said deliveries are a very small part of what our future is going to be. What's interesting on like the reaction in the shares to this delay of the event is that Elon Musk's own attitude towards autonomous driving has evolved. So originally the idea was that you would lease a Tesla vehicle, a consumer car, and it would have all the hardware and software you need to drive autonomously. And when that lease ends, you give it back to Tesla and they kind of create this fleet they control. Or something like Airbnb, where you have your consumer car and when you're not using it, you put it on Tesla's platform and off it goes at the beginning of the day to be a robotaxi. The latest iteration was a purpose-built robotaxi. And I think the street was saying, well, show it to us then. And so a delay is kind of a question on what it will look like and how long it will take to materialize.
Yeah, and again, we're seeing Tesla shares as the worst performer among the Magnificent Seven, losing 6% right now. Now, in contrast to Tesla, which is falling today, I'm looking at Rivian, which is seeing its 5th straight day of gains, now up 2.2% on the day. You recently co-wrote a story about Rivian for Bloomberg Business Week, really starting with this idea that Rivian has a new plan with Volkswagen that's helping its stock recover a lot of ground. Just walk us through it.
Yeah, I've covered Rivian for many years, and long story short, because we wrote 4,000 words about it, they've just hit the reset button. They've rethought how they're going to go from being basically a niche player to a mass market player. Volkswagen has agreed to invest up to $5 billion into them through 2026 and form a JV, and they desperately need that money. They've had some problems getting access to loans which were made available by the IRA, and they have a new plan, which is instead of a shiny new factory in Georgia being their future in the first instance, they're going to launch a mass market car from a plant they've already got in Illinois. They already, it already exists and it works. And it's all about the pressure to scale quickly. And we get really inside the CEO, RJ Scarin's head. So I'm going to post a GIF link on X. Max Chafkin, the co-byline's already posted a GIF link. Get out there and read it. 4,000 words. What better way to spend an evening, morning, lunchtime, or weekend?
Yes, I spent my morning reading it as well. Tesla obviously a big part of that story too, because a lot of the Rivian fan base are former Tesla fanboys or fangirls who have decided that Rivian fits them better, right? Tesla is no longer about the EVs. It's about Elon Musk and the cult around him.
Yeah, it's multifaceted, but in the first instance, with its first generation consumer cars, the R1, loads of those first buyers were former Tesla buyers. But it goes beyond that. They're people that may have been disillusioned with Elon Musk, frankly. Not everyone. There are people that just looked at Rivian and said, I don't want a small Model 3 or Model Y. I want a big old SUV with 3 rows, or I want a pickup. So they went and bought the thing, electric version that they've already driven for years, whether they were driving gas pickups. Now the question for Rivian is, well, that market's kind of been taken now. You're battling with Tesla for the kind of enthusiasts. The mass market is where you're battling Toyota and the RAV4 or Honda and the CR-V, and that's why they need this R2 at the same time that Tesla's also trying to extend its lead as the incumbent.
Yeah, it's a dogfight for sure. Ed Ludlow, thank you so much. Bloomberg's Ed Ludlow, and be sure to check out his article in Bloomberg Business Week. You can do that at Bloomberg.com. All right, coming up, we're taking a look at big bank earnings, which begin tomorrow with a pickup in commercial loans, sparking some questions about second half performance for 2024. And this on a day where the stock market is in retreat, certainly if you look at the S&P 500 and the NASDAQ. But take a look at the Russell 2000, up 3% right now. A bit of a rotation here as investors come out of the big cap names, especially the growth names, and move into some of the smaller, more ignored names. Within the Russell 2000, all 11 sectors are higher, led by healthcare. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. We're going to look ahead to tomorrow because JP Morgan Chase, Citigroup, and Wells Fargo are going to be kicking off the results for big banks. According to Bloomberg Intelligence, fees to power momentum going into the second half of the year will certainly be a focal point. So I want to bring in now our finance team, our powerhouse finance team, Bloomberg's Sonali Basak and Catherine Doherty, for a little bit more. And we'll start off very quickly, Sonali, with just the bank earnings and what you're looking for in terms of the capital markets business, investment banking, fees, and trading from equities and fixed income currencies and commodities?
It's a good question in this environment because obviously a lot of people have been expecting for investment banking to seriously jump back. Underwriting in particular, debt underwriting has been super hot. Equity underwriting has been coming back. M&A has still been a massive question mark. So what does that mean for the banks? Will their businesses really sustain themselves into the end of the year? We have an election cycle coming up. If anyone else has been paying attention, I think there's a lot of question around the numbers you see this current quarter, the third quarter and the second quarter, really meeting up to what you would think through the end of the year. So what they say in their calls about that growth will be important.
Absolutely. So let's bring in Catherine into this conversation, because I bring up capital markets and trading because we always kind of look at that to get a sense of the health of capital markets. But you've been covering Citadel Securities and its new strategy to shake up banks as trading desks. What's going on with Ken Griffin and Citadel Securities?
That's right. So this is not the biggest banks, the ones that we're going to be following tomorrow when they start reporting earnings. These are the smaller banks that are struggling to compete with those big players. Why are they struggling? Costs continue to rise, commissions are compressing, and so how can you compete when you can't invest in your technology and keep up? So that's where Citadel Securities is seeing an opportunity to partner with some of these banks and brokers and essentially provide the services that they've built, they're using in-house, and they find some strategies here that they're still developing in order to give those banks and brokers a boost so that they can stay in the game, and not only stay in the game, but really compete and hopefully grow market share for themselves and continue to serve their clients.
Hey, you know, what's interesting about this as well, Catherine, is this whole idea of this is all coming out at a time where the Basel III endgame rules have not been finalized, and they could include very significant restraints on the trading desks.
That's
this
absolutely true.
This was born, right, from what I understand, out of this idea that capital requirements have been making it tough for banks to trade at length.
And Citadel is seeing that opportunity to come in and say, well, as you are dealing with these constraints, we can help and we can alleviate some of those pains elsewhere and make sure that you have further capital to have flexibility and again, stay and compete and continue to gain market share.
So that raises an interesting point. I'm glad you brought up Basel III in, because we know from Fed Chair Jay Powell that they're still working on coming up with a revised proposal there. How quickly can the Citadel Securities plan come together?
I don't think this is going to be quick by any means. This is something that is going to take a lot of time, a lot of deliberations. The conversations, they need to develop the trust with their partners. The partners need to develop the trust with Citadel.
Yeah.
And Citadel really needs to be able to demonstrate its own risk management and what that means for them in managing their own balance sheet. And those are all things that are going to need to be developed over time. It's not an